Good morning, everyone. It is Friday, May 12th here in New York City. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live, and here are the three things that you need to know this morning. Elon Musk said to be in talks with NBC Universal's head of advertising, Linda Yaccarino, to become Twitter's next CEO. The story, originally reported by the Wall Street Journal, came just hours after the billionaire owner of the platform tweeted that he'd hired a new leader and they'd start in 6 weeks. He didn't give a name, though, at the time. Yaccarino is currently chair of global ads and partnerships at NBCU, an area that's changed course since the Tesla and SpaceX owner took the helm. Advertising has traditionally accounted for the lion's share of revenue at Twitter, but concerns over content moderation and free speech saw something of an exodus last year. No Elon Musk-related news exists in a vacuum, though. The spillover from these reports impacted shares of Tesla this morning. The EV maker stock rose as investors continue to fret over the future of the company, with Musk's focus split among more than just one major business here. The challenges there compounded by a major recall in China today for Tesla on a braking and acceleration defect. It impacts 1.1 million cars. That's virtually every vehicle it has ever sold in that nation. And lastly, the so-called price war is alive and well. Tesla has raised prices in the United States again, and this time on every vehicle except the Model 3. And round two of debt ceiling talks are not going ahead as planned today, but the debate over the chance of default still front and center for many Americans. A meeting involving President Biden and House Speaker Kevin McCarthy now scheduled for early next week. Treasury Secretary Janet Yellen has weighed into the issue again. In a Bloomberg TV interview, she says the only good outcome is for Congress to raise the ceiling. Yellen, however, hasn't been clear on action the Treasury would take if a deal isn't struck by the much anticipated X date.
Elon Musk's reign at Twitter looks like it's soon coming to a close, or at least changing. In a tweet, Musk announcing that he's found a new CEO, NBC Universal advertising head Linda Yaccarino in talks to take over that spot. That's according to the Wall Street Journal and the Washington Post. Under Musk, Twitter cut staff by roughly 75% and saw a big exodus of advertisers. Insider intelligence cutting the company's ad revenue forecast by $2 billion after the takeover. And I say his role there is changing. It's not like he's stepping down. He's saying he would still be the CTO.
Right.
And I think there are a lot of questions remain about how much control he would cede, right? It seems like he is looking for someone very specifically to wear the advertiser hat, and he would wear the sort of programming and product hat.
Yeah, systems operation, chief technical officer, things that he's done in the past if he does remove himself from that chief executive officer role. At SpaceX, he is still vocal, though he is not necessarily the head of the operation on a day in, day out basis that takes place. But this also gives an indication of where he does need to spend his time elsewhere at a publicly traded company in Tesla, as we continue to watch that particular story unfold in front of our eyes, and the public markets tracking that extremely closely as well, on the pricing wars all the way into entry into new markets. And then on the SpaceX front too, remember just a few weeks back, SpaceX had a failed launch, a rapid unscheduled disassembly, as it was called in their press release, just minutes after it took place. And so all of that considered, when you've got these major businesses that one entity or one person in Musk is running, and for shareholders that are very much watching to see where that time is spent, I think for Tesla shareholders, they're watching this and saying, okay, this couldn't have happened soon enough, as we're now waiting to see where you're going to perhaps maybe not be sleeping on the factory floor as much anymore, but at least spending more of your time focusing on Tesla right now.
Right, focusing on Tesla and focusing on what he's good at as well, right? He has been sort of disdainful of advertisers, or sort of gone between being disdainful and begging them to come back, right? And I think some of the figures that the Wall Street Journal has reported, citing Sensor Tower, which is a market intelligence firm, are really telling that of the top 100 advertisers on Twitter, pre and post Musk, 37 were not spending any money on advertising on Twitter in the first part of this year. So that's quite a high number. I mean, we don't know what their proportion was of spending before. We just knew that they were of the top 100. But, we know that there have been cuts across the board. So he doesn't have to pay attention to that as much anymore. And then, as you say, he's got a lot of stuff to take care of at Tesla. There have been a lot of price changes in the Tesla vehicles throughout the year. Most recently, it looks like there have been reports of them raising prices again on Tesla, on the Model S and Model X.
Right.
There's a big recall in China going on that we're going to talk about much more later in the show. So he's got pressing issues that need his attention. And the team at Tesla is sort of more formed here. But nonetheless, it's something to think about. And
just to briefly give a spotlight to Linda Yaccarino as well here, a person that has, in the role currently right now at NBCU, been able to put together partnerships with the likes of YouTube, Snapchat, Twitter in the past, even kind of having a more direct focus on where those other opportunities for the entity could move forward. Right, and there's no report from CNBC that says she has resigned from NBC Universal. Wow. The timing of this, by the way, is really fascinating and potentially negative for NBCU because she was set to lead their upfronts presentation this coming Monday. That is the key presentation that the various networks, streaming services give to advertisers. It's their sales pitch to advertisers for the upcoming slate of programming. She was set to do that on Monday. So when this news came out, when these reports came out that she was going to potentially be heading Twitter as CEO, there was a question there, like, this lady's supposed to do a very important job on Monday for NBCU. But now, again, CNBC is reporting that she has resigned. So, again, this gives credence, obviously, to these reports that are out there that she would be taking the Twitter job. Yeah, absolutely. And for Twitter as well, this would kind of put them on a different platform if Yaccarino does take over this role, which it now has more signs pointing to that being the reality. A person that's also involved within the World Economic Forum. You wonder, as she chairs the task force for the organization on the future of work and media as well, media, entertainment, culture, where all of this will lead to a better profile for Twitter, how Twitter can have kind of a seat at the table in one way or another. But all of that considered, it seems like we're moving more full speed ahead than we were even just 2 hours ago on Linda Yaccarino becoming the next CEO of Twitter. And one more small thing as we talk about that. NBC Universal is owned by Comcast. So my first instinct was to take a look over at Comcast to see if there was any kind of reaction there, perhaps, to her stepping down, since she is seen as a major player there and an important figure for NBC Universal. Right now, I'm not seeing any particular reaction in the shares, it looks like. So either Comcast is not always super heavily traded in the pre-market, we should note that, but still, that's something that we're going to be keeping an eye on to see if there ends up being any kind of reaction. Absolutely. We're going to be watching shares of MCSA going into the start of today's trading activity as well and continuing to track this story. Also here, everyone, if this week's inflation data is any indication, the end of rate hikes might be within sight. The Consumer Price Index, a key inflation gauge, up 4.9% from a year ago. That's just a touch lower than March's 5% figure. And the Producer Price Index, that PPI, as you note in your hood, which the Fed prefers, rose 2.3% on an annual basis, below estimates and the slowest annual increase since January of 2021. Now, markets, they are pricing an 84.7% chance of a pause in June as of this morning. That's down slightly from the day prior, with 1 month to go until the Fed's next meeting. Our next guest is keeping the bullish sentiment in the near term, raising its target on the S&P 500. Barry Bannister is Chief Equity Strategist at Stifel. He joins us now. Barry, walk us into your target here and ultimately what you're anticipating the tenor or the tone in the conversation, at least, at the next Fed meeting to be.
Well, back in October 24th of 2022, we came out with a bullish view that the S&P 500 would rise as much as 600 points from, at the time, it was around 35.75, 35.80. We thought it would do it in 6 months by the end of April. Of course, there's been a good direction up. The first 500 points of that move, which would be led more by cyclical than defensive, and cyclical includes big tech as well as industrials, and we've talked about that, that first 500 points was the easy money. All that required was things not to go wrong. In other words, no near-term recession and lower inflation, which were our call. But the next few hundred points, 250 points or so to 4,400 by the summer, that's the hard money. The easy money is behind us. The hard money is here. And that requires things not to go, before it was not to go wrong. Now things have to go right. We are seeing encouraging signs, though, of economic resilience. Consumers are still sitting, households, on $1.2 trillion of cash, far and away above the normal trend line. Businesses are fairly flush with cash. EBITDA to interest coverage ratio and so forth looks very good. I don't see the makings of a near-term recession. What we are looking at, though, is some problems probably by the fourth quarter of the year, so it is a short-term call.
Well, and Barry, hi, it's Julie here. It's good to see you. I noted that mention of economic resilience in your note. At the same time, we're hearing from the likes of Federal Reserve Governor Michelle Bowman, who's speaking in Europe this morning and saying there is the potential for another interest rate increase. That's something that other strategists have floated as well. If that economic resilience comes with another rate increase, is that going to be damaging to markets? In other words, if everything has to go right, does that include a pause from the Fed? Does that fall into the category of going right?
Well, keep in mind that two things have happened. One, earnings have actually come out a little better than expected. If you take the percent of companies in the S&P 500 index that beat the estimate and subtract the percent that missed the estimate, so the beat-miss difference, it actually turned up nicely in the first quarter. And when that has happened in the last 20 years, the S&P 500 on a year-over-year basis starts to go up. And it's doing it again. The second thing is, if I look at the interest rate, it is about 5.25, and that's from the Fed. Keep in mind that inflation is closer to mid-fours. So the real interest rate, the interest rate after inflation, is a little less than 1%. Fed cycles in the last 50 years since 1971 typically ended at over 2% real rates. And so we're not really that tight. We just came from sub-basement level 5. In other words, we were at minus 5%, 5.5% interest rates after inflation when the Fed cycle began. And we've only caught up to barely above zero. The other rate that matters is what's called the 10-year real yield, or 10-year Treasury inflation protected securities, or TIPS yield. Very important for valuation. That is around 1.2. If you look at the pre-global financial crisis era, it was always around 2 to 2.5. So we're at half the real yield of the past. So it does preserve valuation and enables stocks to have a higher valuation when interest rates after inflation are actually quite low versus history.
Where is the largest valuation upside from an equity perspective?
Well, we've seen strength in technology, which is software, semiconductors, computer hardware, which includes Apple. And we've seen some strength in selected communication stocks, such as the internet. Typically, they can go higher on the valuation than where they are now. And the most beaten down, downtrodden names like banks and some of the industrials, some of the basic materials represent good value if we can avoid a recession, certainly until late in the year. So what we've done is barbell. We think that there's still some upside on tech, consumer media, communications related names. And also there's some downtrodden value in the names I just mentioned, such as banks and industrials and materials. So we would barbell the two into the summer and have a weighting in both. What I would avoid is making a defensive bet, everything from pharmaceuticals to utilities to household products. They just don't look interesting to us right now.
Interesting. Interesting that you find them interesting. Barry, thanks so much. Barry Bannister, Chief Equity Strategist at Stifel. Good to catch up with you this morning.
Thank you.
Let's take a look at Robinhood. Those shares are a little changed before the opening bell, but we have seen them rise as of late, cooling down today only from the pop the stock got from its first quarter earnings report, which showed a jump in interest income due to Federal Reserve rate hikes. Revenue for the quarter coming in well above estimates at $441 million versus $423 million estimated, which is a 16% jump since last quarter. Adjusted loss per share coming in 1 cent worse than expected, and Robinhood saw a decline in transaction-based crypto revenues falling up 1%, while equities revenue increased 29%. Robinhood monthly active users slipping to 11.4 million. But the big news here, the online brokerage announcing a 24-hour trading platform 5 days a week. That is set to launch to some users next week and then will roll out more broadly here. We've got a lot of questions for Robinhood CEO Vlad Tenev at 10 a.m. Eastern, including about that new offering of expanded hours of trading, including the increasingly diversified lines of revenue for Robinhood that led to that bounce in the first quarter, and including where Robinhood is going from here, both in terms of its profits and in terms of regulation. You don't want to miss that conversation.
Today's morning brief is on, you guessed it, artificial intelligence. The title, the market's obsession with AI is not the right magnitude. Yahoo Finance's Miles Udland writes, with a seemingly endless discussion of artificial intelligence and its potential across industries, the level of conversation happening about it is not right. Either we're talking about it way too much or way too little. Here's what some of our guests had to say on the space, the artificial intelligence space, this week, starting with Builder.ai, which just got a big investment from OpenAI backer Microsoft. Here's CEO Sachin Duggal.
You know, when we think about what's happening in the world at large, and this is, you know, before ChatGPT and what we're seeing with OpenAI, we've seen a rapid push towards digital transformation. Whether it's a small business, it's entrepreneurs that are trying to build ideas and they need to be digitally native. And companies like ours are using AI to accelerate the productivity for them to get to that endpoint, right? So they don't have to become software experts. They can simply talk about their idea. We can recommend the right set of features depending on which region in the world they're in, what kind of features they're building. Broadly speaking, I think where you're starting to see this play out into everyday life is productivity applications. You think about things like Copilot. They're going to help us do a lot more with a lot less. And that means that if we think about the aggregate amount of demand for work that even comes into a startup like Builder, and the aggregate amount of supply we have, whether it's our expert network or it's our own teams doing internal work, this actually helps us level the playing field and brings back some balance for a lot of folks.
And education tech group Duolingo is no stranger to the technology. CFO Matt Skaruppa joined us after its first quarter earnings beat expectations. The business has been outspoken on how AI can help scale education.
AI for us is a really integrated experience. So for a long time, users have told us that they wanted to interact with our product. And what AI does is it's a really quick, or the generative AI is a really quick response mechanism. So we're able to integrate much more tutor-like conversational response times into our product. So it's a really natural fit for us. And it's something that in our early testing of this new tier, we do see demand for. So we're excited about it. How big it can go, we're not sure yet. I mean, it's early days. So we're going to keep testing and rolling it out over the course of the rest of the year. But we're very excited about it.
Ohio's finest also getting into the space. Wendy's making a big push and integrating AI into its all-important drive-thrus. CEO Todd Penegor caught up on its plans here on Yahoo Finance.
So what you're going to see today is basically just taking out the traditional order taker. You won't even know that it's AI taking your order, but you'll be talking to the voice of Wendy's, be it a consistent voice. It may upsell you along the way today.
Todd, is it your voice? Is it your voice?
It's not my voice.
Okay, just want to check.
God help us, Brian. But no, we'll have a consistent voice out there. But what we'll have on the digital menu boards is a confirmation. So you know that your order was taken right. You'll get to see it real time. And then ultimately we'll get you through the restaurant very quick. So when you think about different languages, different dialects, we'll be able to quickly make sure that nothing gets lost in translation, both from a customer or an employee perspective. But over time, as you start to think about how do you take a digital menu board, how do you make it a smarter digital menu board, how do you connect, the voice AI, the digital menu board, ultimately to our loyalty program, how do we make sure that we got a more personalized, customized menu to support what Brian wants when he comes to the restaurant? How do we trade you up when you come into that restaurant in the future? Those are all opportunities, a little further off, obviously, but you got to start laying the pipework and the platforms today to really bring all of that to life.
And Nextdoor also jumping on the AI train. The company looking at ways that generative AI can enhance the way neighbors communicate with one another. CEO Sarah Fryer joined us yesterday to talk about it.
Yeah, you just can't get left behind when these huge technology shifts happen. So you're right. If you look at Nextdoor, we've held our operating expenses about flat for the last 3 quarters. But if you look at what's been going on effectively under the hood, we have been hiring up a big AI team. We started that investment back really in 2021, going into 2022. It's not just about generative AI, right? AI has been underpinning platforms like Nextdoor for many, many years now. We use that data to do things like a better notification, right? The right notification to the right neighbor at the right time brings them back to the platform. It's a way we personalize the news feed. So the things that work for me may not work for you, Brian, but we try to make sure your feed is personalized for you. So we do have to keep investing here. We have to stay really out in front. And we wanted to move fast on the generative AI front because we wanted to let anyone, any neighbor in the world that's on Nextdoor gets to see what this technology is like, gets to benefit from it. And we think that's an important part of really democratizing a whole new wave of technology.
So everyone seems to have an opinion on the AI space these days, from companies to policymakers and academics. We caught up with Danny Blanchflower, who is the former Bank of England policymaker and now economics professor at Dartmouth College. He didn't really mince his words.
The Luddites thought that technology was going to be job destroying. But if you look back over, let's say, the last 25 years, actually lots of new jobs have been created around technology. When you have your dishwasher repaired, the plumber doesn't come, the computer guy comes to sort of impact, to deal with the computer that's in every one of your machines. I mean, yesterday my coffee maker is blocked and I got a message on my phone saying there's a problem with your coffee maker. I think that's the first thing. I think this is job generating, it's just job different. And I think in a sense your question is something I've thought about endlessly. But if you think, let's say I was to go back each 10-year period and you say to me, so what do you think's coming? What are the new jobs over the next decade going to look like? And the answer is I would have had it wrong. It would have been very hard to work out that be an Apple store and I'd be talking to Yahoo Finance on my Zoom. So I think the answer is it's hard to know, but I think there's big changes coming. Obviously, we're seeing this technology impacting things. Zoom is a big deal. And we're seeing evidence that the inner city is in decline. So if you look at things like, beeps of phones in downtown. In San Francisco, it's about 25% of what it was. In Boston, it's 50%. The character of working has changed, but jobs have changed, and we're seeing rapid change around this technology. In many senses, it may well be job enhancing, not just job destroying.
I love that Danny got a message on his phone that his coffee maker was not operational. And I also liked the point that our Miles Udland made in the morning brief is that this is either going to be a blockchain technology, a metaverse, something that was extremely discussed, that was not world changing, or we're actually not talking about it enough because even more than those technologies, at least in our minds and in theory, this has a bigger potential to change many, many, many different businesses and the way we sort of conduct our day-to-day lives. Yeah, and we don't really know yet.
We don't know yet. However, what we do know is that if there were investors out there trying to get ahead of the artificial intelligence trade and try to get kind of a sense of where some of the totem pole elements start to come together around the generative artificial intelligence specifically here. You kind of got that through the earnings calls that took place. And I think back to the Meta Platforms earnings call where Mark Zuckerberg, in his very monotone way, did deliver something that was extremely valuable, I think, for investors who are trying to understand where the parts of generative AI are to potentially invest in. And I kind of broke it down into this acronym, AMC, and at the top of it, you have the applications. In the middle, you've got the models, those language learning models that the applications are built on top of. And then at the bottom of that, the foundation of that entire generative AI house, if you will, is the chips. And the chips that we've heard, or at least the kind of data center or semiconductor plays that we've heard so far, a lot of companies pointing right now back to NVIDIA and how much they're leveraging or intend to leverage the DGX cloud, which we had heard about an earnings call ago for NVIDIA as well. And so kind of thinking about it within that acronym, I think a lot of the conversation from an investment standpoint is, well, it seems like chips are really going to be the core focus of this and could be a near-term and long-term kind of leader in terms of where the longer return to value for shareholders would be in the generative AI landscape.
I mean, it's also interesting how many different other companies are using ChatGPT specifically. I mean, Nextdoor, for example, is using ChatGPT as a foundational product for its AI offering. So then that goes back to OpenAI, which goes back to Microsoft. So that also is something that investors are clearly thinking about.
Yeah, and even translation too. Brian Chesky told us from Airbnb's perspective, they want to just be able to run simple language translation. That's one of the lower hanging fruits.
Theirs does it already.
Right, exactly.
If you message your person and they don't speak English or don't speak whatever, it translates it. All right, coming up, Southwest's pilots union approves a strike mandate. No stranger to scrutiny in the last few months. The news comes just ahead of the busy season. We'll have the potential impact next. Opening bell on Wall Street coming up in just about a minute here. We are looking at a week that has actually been relatively positive here, but it does feel like we're kind of having this moment of sideways movement. Yep. We're waiting for retail earnings, which really start in earnest going into next week and beyond, and the next Fed meeting as well. But in the absence of that, there is a little bit of a drifty feel. Yeah,
you've gotten a little of kind of the earnings luster that kind of ran at a lull this week for a bit, coming off of some of the big tech earnings of last week and the week prior, and so now waiting for those retail earnings. But taking a look at the sideways trade, the Dow Jones Industrial Average past 5 days really only up by about 0.5%, so fractional move higher there. Past 5 days for the Nasdaq, though, looking pretty good for the tech-heavy average. It's up a little more than 3% over that period of time, and the S&P 500, you're seeing that up over the past 5 days by about 1.7% right now.
Yeah, so I guess it hasn't been that sideways. I guess it's been up, at least for the past week, right? At least for the past week. One of the things that's been holding back the Dow this week, as we have been noting throughout the week, is what's been going on with energy shares and oil itself. Oil has been trending lower. Energy shares have been trending lower. That's something that's more heavily weighted in the Dow. Well, now that the markets have indeed opened up, let's take a look at the opening prices sponsored by Flex Shares, and all three major averages ending the week on an up note, at least for now, ending the beginning of the end of the week on an up note, at least, with all three major averages higher by the neighborhood of a fifth to 0.25%, Brad. And as we get underway, I know you like to look at the sector action as well to see what's going on there. I'm curious not just on the day, but also there on the week, what kind of action we have been seeing.
Yeah, let's load that up for our friends at home. Taking a look at the past 5 days here for the sector movement here, and it's really been communication services that's been the leader of the pack, the 11 S&P 500 sectors over the course of this week. That up by about 2.5%. And then additionally, consumer discretionary, interesting to see that up by about 1.6% this week. However, bringing up the rear or the caboose, materials, even though it's up here today by about 0.3%, you're seeing that down by about 1.8% over the course of this week. So more laggards than gainers.
Yeah.
However, ultimately here, still looking at a fractional move higher here out the gate for the S&P 500, up by about 0.25% over the course of this week, only up by about 1/10.
So if we switch on over to today's view, you see much more green on your screen for today's, and energy, which again had been the laggard of the week, is now gaining on the day. Should we check on some cryptocurrencies, Brad? I know that's an area you watch closely, and we had been seeing earlier in, I don't know, a couple of weeks ago, right? We had seen Bitcoin creeping back up to 30,000, but that feels like it's not quite in sight at this moment.
Yeah, playing a lot of hypotheticals in the Bitcoin or the crypto head, of course, that a reference to Lake Street out there for all the fans. But at the end of the day, it's really just a matter of where the hypotheticals and for some of the psychological levels, this move continues to transpire here, and especially over the course of the regional bank news that's continued to come forward over the course of this week, because that's what that move that you saw back in March. I don't have our highlighter lit up, but anyway, back in March, you can see that level that we really skyrocketed off of, and were able to maintain above 28,000 for a while, nearly got, and I believe did crack above 30,000, didn't sustain there, and we're seeing that move back to the downside as of right now, but still year to date up by about 59%. You've had some interesting activity on a development front, on a chain front for Ethereum or Ether. Of course, could be a controversial conversation, what you're calling it at your home, but at the end of the day, it's still up by about 47% over the course of this year.
I'm trying to imagine the homes that are arguing about whether
to call it
Ether or Ethereum. You want to look at the banks here just to close this out, since it has been, or let's look at the regionals, since it's been such a wacky week again, and what's going on with the regionals. So it looks like more in sort of recovery mode than not here today. Pac West up just about 1.25%. So not seeing a huge gain here, but obviously there's been a lot of turmoil continuing in that sector on the week. Let's get to some individual movers as well, and Southwest is one of them, facing some possible turbulence after pilots for the airline voted for a potential strike as extended contract negotiations come to a head. Now, we don't know yet if the strike is actually going to happen. This is authorization for a strike, and they called an early end to voting after all of them. I mean, it was pretty overwhelming, this vote to authorize the strike.
Yeah, this is not the first strike that we've seen authorized. Not all of them actually go through to a full-on strike that disbands or at least impacts some of the day in, day out operations. We had seen one from American Airlines, of course, that was earlier this month. even the Delta Pilots Union, they were able to come to an agreement eventually and negotiate with the executives and leaders. And we'd asked and spoke with Delta CEO Ed Bastian about that in the past for about 2 quarters at this point. And so usually these net out well for the pilots. And this is right for the pilots to do, considering the changing fleets of aircraft that they're also going to be asked to pilot or to steer the ship on. And so what they're asking for within this specifically, and what the Pilots Association that represents about 10,000 pilots for the Dallas carrier, just taking a look at the authorization vote, it closed after a week and a half, 98% participation, 99% of pilots voting to authorize the strike, and the statement saying that the lack of leadership and unwillingness to address the failures of the organization have led to this point, and the pilots are tired of apologizing to passengers on behalf of, get this, a company that refuses to place its priorities on its internal and external customers there. So those are some fighting words, as we would call them here on this Friday.
Yeah, most definitely. So we'll see if the strike actually ends up happening now.
Yeah, exactly. Let's also talk about News Corp this morning. News Corp getting a boost after the company used cost-cutting measures to lead to a profit beat for the third quarter, and saw total subscribers for its consumer products cross 5 million there for News Corp. You're taking a look at shares up by about 7.7% here this morning.
Yeah, I'm interested when I talk about this company to think about the company that was formerly part of it. I'm talking about the company now known as Fox Corp, right, which has some different issues to deal with here. This company has Dow Jones, it has book publishing, it has news media, digital real estate. So it's a conglomerate on more of the text side of the business, more or less. And if you look across the different lines of business here, there are some clear areas of strength versus weakness. Subscription video service revenue was down. Digital real estate service revenue was down. Dow Jones revenue was up by 8.6%. So you see the kind of differences in the different businesses. So it still has sort of a diversified enough business that there is some give and take here, but without the Fox Corp business that was once a part.
Yeah, it's also really interesting on the net income perspective too, where the net income was $59 million. You compare that to $104 million in the prior year, so essentially slashed in half there, and it's a wonder of whether this was just kind of a beat on lowered expectations already for the business. And I mean, we're kind of seeing that in the stock price anyway, in tandem with a few of the other bright spots.
Yeah, I mean, they have been cutting costs, like everybody's been cutting costs, and they are affected by the advertising business. So, again, that kind of push and pull, if you will, in different parts.
Well, talk about pushing and pulling, or swiping left or swiping right. Coming up, still swiping? Dating app Bumble reported strong revenue growth last week, but is this really a high growth market, or is it past its peak? We're going to speak with the company's president. That's coming up next. Shares of Bumble, they are trading down over the past month by about 3%. The company reporting better than expected first quarter earnings, though, last week. Revenue coming in at nearly $243 million, about $2 million higher than estimates, and jumping nearly 16% on an annual basis. Adjusted earnings per share with a slight miss, though, 1 cent versus nearly 2 cents. Bumble app revenue, though, that grew 26% since last year, and total paying users increased to 3.5 million, 15% jump on an annualized basis there. And one thing everybody's watching here, AI. Yeah, we said it. Bumble currently testing a new premium paid feature called Best Bees, which leverages machine learning to improve curation of compatible matches. For more on this, we turn to Bumble president Tariq Shaukat, alongside Yahoo Finance's executive editor, Brian Sozzi. Great to have you here with us this morning. First, walk us through the quarter. We'll start there, and where you're seeing some of the trends among people who want to find love out there, or even a business connection, because we know that there's business connections, there's best friends, and there's finding love within the platform. Why they're spending into the experience more right now?
Yeah, well, it's great to be here. Thank you for having me. As you mentioned, we've had a great first quarter, great start to the year. Revenue at $243 million, up 16%. Bumble app revenue leading the way with 26% growth to almost $194 million, and with growth in our EBITDA margin as well to 24%. So we thought it was a really good quarter, and it really is powered by just consumer demand. We are seeing demand really around the world, in the U.S., in Canada, in Western Europe, in parts of Southeast Asia and Latin America, really be very, very strong. At the moment, our what we call top of funnel, new registrations, new people coming into the market, are really powering the business, including with the Gen Z segment, which is obviously very critical for this business. And then some of the new products that we've been launching are really catching on and converting people into paying users. So we really think that we're really firing on multiple dimensions at this point.
Tariq, we're hearing from a lot of leaders, consumer leaders that lead consumer businesses, maybe such as yours, that those people earning $75,000 a year or less are really struggling right now. Inflation, job loss, whatever it is. Do you think for that cohort, they will sign up for a month and maybe roll off, and for them, it will be a loveless summer?
Well, we are seeing a couple of different things in the market. First of all, people really still want to date. And if you think about the experience that you get on Bumble and think about how easy it is to meet a number of different people, it's actually a really good value. You compare the cost of a Bumble subscription to going to a bar and buying 2 drinks in New York City, and it really, I think, compares quite favorably. And we hear that time and again. This is actually a very efficient way to go out and meet new people. So that's absolutely one thing. We are seeing robust demand for our subscriptions. Our new subscribers continue to lead the charge. As we talked about, we've seen payer user growth. We now have 3.5 million paying users. Those new subscriptions are continuing very strong. There are some pockets, particularly in the Gen Z segment, where we are seeing some people saying, I'm going to do a month or two and take a break, but really, it isn't slowing down the company. We're delivering the 26% revenue growth on Bumble app as an example, even with those dynamics that are going on. So we think the demand for love and for connection is really, really strong.
Tariq, I have to admit, I would much rather spend my money out at a bar with my friends than on an app. But I'm married, so it's not really applicable to me. I met my husband the old-fashioned way at a party, although I was on apps at the time as well. But in any case, do you see your main competitor, I guess my question is, as real life, IRL, right? Or do you see it as other dating apps?
Look, this is not the pandemic anymore. People are not going to be doing endless dates on video chat, and that's not what we want. What we want is to make sure that when you do meet in a bar, when you do actually go out to dinner, when you do actually go for a walk in the park, whatever it is that you want to do to connect with somebody, it is a real connection. It's a connection that you have some chemistry with. So you're not showing up and saying in the first 5 minutes, ooh, I really shouldn't, this is the one I thought it would be. This isn't the person I thought it would be, et cetera. And so we really think this is a safer way to date. We think it's a way to improve the quality of your first dates. And our business is all about connecting you in real life. It is not about connecting you virtually. We just use the mobile app as a way to help you connect with people.
Well, one of the new ways that people are finding out even how or who they can connect with is simply by saying, you know what, I'm going to put a pair in my profile, and I'm also going to perhaps put a ring on and go out, and people will see that ring and they'll know, yeah, I'm out here to be talked to. I'm trying to catch these. I'm trying to catch the likes in real life. So with all of that taking place and the kind of the fusion of that experience, what do you view as your competition right now? And how does Bumble even need to reinvent the experience to be more off-premise or engaging more of the in real life connections?
Yeah, it's a great question. And we have a program that we call Bumble IRL. And the whole point of that program is to create real life experiences that singles are going to try and meet people in real life. So we really view our competition as other dating apps, as other online players. We don't view IRL as competition. We view that as success, right? We view you actually meeting somebody that you like in real life as success. And if we can help you go to a bar and find somebody who happens to be there, that's great. So we've been leaning into location, into events, into locations that are places where singles want to go. We are leaning into how do we connect you by interest so that we know that you are both interested in soccer and want to go see a soccer game, or you're both interested in wine and hey, let's go to a wine bar. So we're really trying to make sure that whoever we connect is being connected so that they can have a successful first, second, third date, and hopefully a successful relationship in real life. And in real life is not a competitor. It's really a complement to the business.
Tarek, I want to go back to the AI debate here. And if I read your earnings call right, you're now using AI to help, I guess, people improve their profiles, put up better photos. How does that hurt the dating experience? If I show up and I can't deliver on this perfect image, I don't know, maybe and the date goes bad, I'm off the platform. It hurts my chances for future dates, no?
Well, so I think AI is doing a couple of different things. I think the first part is it's really helping remove some of the friction. It's helping you make the choices that you're already making in the dating app. So we're not altering photos, we're not adding filters, we're not doing things like that change who you are. What we're trying to do is say, if you're setting up a profile and you've got 8 photos, here's the one that's likely to work the best of the ones that you currently have. We want to maximize the chances that you are successful as your authentic self. And that is a really important piece. AI for us is really a complement. It's an assistant in that dating experience. We're also using it to help match people so that we can figure out what you're interested in and who you are and help you find the most compatible, the most curated set of matches. And we think that leads to more success on the platform, not less. We are all about success for us is finding you that connection that is special and that you want to continue.
What about for people who are using AI to write their profiles? I mean, that feels like not necessarily the most authentic representation of yourself or your own way of thinking if you're just saying, this is what's going to be successful for me and what the response rate is probably going to look like if I have AI write this versus me putting my own authentic words into explaining or describing myself.
Yeah, one of the biggest concerns people have with online dating is it a real person, and is the person representing themselves in the right way? And we think that AI can be very helpful in that it can detect bots, it can help keep you safe, it can actually keep conversations safer. We can say, ooh, do you really want to say that before you send a message? So there's a lot of really things that AI is doing already today inside of our apps that is helping to improve the experience. And it's going to be what we know works the best is when you can bring your authentic self to the dating experience that is inside of the app and in real life. To the earlier question, we think that AI can really be helpful there. And we have a very big focus inside the company on what we call kind connections. How do we make sure that the connections that you're making are kind, that they're safe, that they're authentic and real? And we think that AI is going to be very helpful in helping us accomplish that. But we have to be vigilant. We don't want people out there misrepresenting themselves. And we are a community that prides ourselves. Our members really believe in the power of community and in the quality that we bring to the Bumble, to all of our experiences in the Bumble app.
A good number of folks, Tarek, are concerned about a recession this summer and really continuing into the fall. How do you think that would impact the dating industry and human connection?
Well, I think if we learned one thing in the pandemic, it's that people want to connect. People need to connect. People, there is a Surgeon General said it just, I think it was last week, that there's a real crisis of loneliness out there. And so we know that the demand for connection, the demand for dating is really just, and not just robust, it's indestructible. It's really something that is, you see it in boom times, you see it in recessions. What we have to do is make sure that we are helping people break out of that. Recessions can be lonely times, they can be stressful times, and we know that the connection business is one that can really help people at a very human level, and in a very, very tangible way. And so we are all about how do we make sure we bring those connections to life, and help you do it in a way that is suited to your lifestyle, to your economic means, et cetera.
Tarek, thanks so much for taking the time. We really appreciate it, and hopping on here with Yahoo Finance. Tarek Shaukat, who is the Bumble president, alongside Yahoo Finance's executive editor, Brian Sosny. Appreciate it.
Appreciate it. Thanks so much.
Thanks. Guys, coming up, Elon Musk says that he's got a new CEO for Twitter potentially in mind, and it might be NBC's ad sales chief. Tesla shares, they popped despite a major recall in China. There's too much going on. Luckily, we've got Wedbush's Dan Ives to make sense of it all. That's coming up.
NBC Universal's global advertising head, Linda Yaccarino, has resigned from the role. It comes after reports that linked her to the Twitter CEO job. That report was hot off the heels of a tweet from Elon Musk announcing he had found a new leader for the social media giant. He did give a name at that time, but put everything together, it seems like it could be Yaccarino, according to these reports, and that she's now left her old job. Wedbush Security says Musk leaving Twitter's head role could be a major step forward for Tesla, raising their price target on the EV maker. Senior equity research analyst and friend of the show, Dan Ives, is joining us now. Wait, Dan, you're in Thailand? Am I reading that correctly?
In Thailand, yeah. I'm here on a 2-week Asia trip visiting investors. So I'm in Bangkok today.
Oh, I was really looking forward to seeing you in your fun shirts in your New Jersey, in the New Jersey office, so to speak. But thank you so much for talking to us from there. So this is really interesting that Musk seems to be making this move. It's not as though he's not going to be paying any attention to Twitter, though. He's going to be, as he says, the CTO. So how much do you think he'll really be able to bring his full attention back to Tesla and his other endeavors?
Look, I mean, Julie, I think it was a significant overhang in terms of worried about distraction with Musk at such a key time for Tesla. I mean, as the arms race plays out, price cuts, that we're seeing, and this was very important in terms of a distraction risk. Look, if it's Linda, and obviously it looks like, it is going to be her as the CEO, I view it as a home run hire because from an advertising perspective, it's exactly what Twitter platform needed, and now Musk could do what he does best.
Does this and Musk now being able to, hopefully near term, place more of his time at Tesla make it better or more of it or more of a bull indicator if Elon's able to say, work on the 4680 battery and really work past some of the hurdles that have come to light there with Panasonic?
Look, Brad, he's the hearts and lungs of Tesla. So as a Tesla investor right now, you want Musk doubling down on Tesla, as well as, of course, SpaceX. The last thing you wanted was the distractions to continue. Look, at first he was going to stay on as CEO till the end of the year. They call it lightning in a bottle. I think it's a home run hire. And for Tesla investors, it's a relief on two ways. One, Musk distraction risk. And two, it's a great CEO pick that ultimately is really going to, I believe, help navigate the ship.
Dan, I want to ask you about what's going on at Tesla in the background here. And I'm talking about the huge recall that is happening for Tesla vehicles in China. Now, I know if you have a Tesla, you don't have to drive it back to the dealership and get them to keep it for a while. You do a so-called over-the-air update. And even though this is about a braking issue, it's happening that way. But still, where in a country where China that is, where Tesla has already had a lot of reputational hits, what does this do?
Look, they need to continue to sort of navigate the tightrope there. Clearly, there have been issues there, but it's the hearts and lungs of the growth in Tesla. And I think this is going to be a continued issue going forward that they need to start to contain. I think right now investors recognize that there's major steps in the right direction that have been taken, but clearly some more wood to chop.
Dan, within your coverage universe, of course, many of the companies have already reported earnings. And even as you think about what still is left in this earnings season, for the lust that there was for companies like Apple, companies like Tesla, and seeing what was in their reports that we could then point to for the rest of the earnings season, what we may hear from companies, it's largely been relief. Do you think that relief is just going to turn on to a sideways trade for the rest of this earnings period, given what we had already seen on depressed or compressed expectations for some of the tech companies thus far?
Yeah, look, I think investors were not correctly positioned. I think tech better than feared. We saw resilience on enterprise, saw it on digital advertising. Cloud continues to be robust, and these companies cut costs significantly. I think the trade in tech is higher. I think tech stocks are up another 10 to 15% rest of the year, despite the macro, despite some of the worries out there. And I think ultimately it's become the new safety sector. And I think now we're going to see more mid-cap tech start to catch up with big tech.
Some quick math tells me it's 8:54 p.m. in Bangkok, Thailand right now, Dan. So we will let you go, and hope you have a great weekend and 2 weeks over there, it sounds like, as well, working some sources. Dan Ives, Wedbush Senior Equity Research Analyst, joining us here from way downtown. Thanks so much, Dan. And coming up, everyone, 24/5 trading. We'll speak with the CEO of Robinhood on the platform's latest push. That's coming up next. Happy top of the 10 a.m. hour to you folks at home. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We are taking a look at the markets here this morning. We are mixed right now across the U.S. major averages here. The Dow and the S&P 500 still in positive territory. However, the Nasdaq has drifted into negative territory right now, flat, just barely to the downside though, by about 8 points for the tech-heavy average. Now over to Julie for some breaking news.
Yeah, we have the University of Michigan Confidence Index for May coming in, the preliminary number worse than estimated and showing a pretty sharp decline from April, down 9% to an index reading of 57.7. Current conditions going down to 64.5, expectations at 53.4. And there's some really interesting commentary that I want to point out from Joan Shu, who's the Survey of Consumers Director in this release. First of all, she points out that it is negative news flow about the economy that is affecting consumers. But not only that, guess what? People are paying attention to the debt ceiling debate, and that seems to be feeding through into confidence as well. So it's not just that the American people in polling don't have a lot of confidence right now in Washington. It's that they're listening. They're upset about the debt ceiling situation. I thought that's really interesting here, Brad, that she points to that.
Yeah, absolutely. They also added throughout the current inflationary episode, consumers have shown resilience under strong labor markets. That kind of pairs back to what we had heard from a lot of the bank CEOs over the course of the earnings season, saying that the consumer remains healthy. But the anticipation of a recession is what should also get attention here. They're saying the anticipation of recession among consumers will lead them to pull back when signs of weakness emerge here.
And not only that, that if the debt ceiling crisis is not resolved, that the dismal views on the economy will exacerbate the dire economic consequences of the default. So this is a little interesting and unusual here. These reports are usually pretty straight, right? But this almost is once again leaning into what we've been hearing from the likes of Janet Yellen, from business leaders, from the president, that there will be dire consequences if there is a debt ceiling breach and potentially a default.
Yeah, absolutely. Played into the expectations for the economy, plummeting 23% from last month. Long run expectations sliding by 16%.
Yeah, exactly. All right, now to a company that experienced rocketing growth during the pandemic before going public in July 2021 at a valuation of about $32 billion. A beneficiary of low rates and the so-called meme stock craze, it saw use among younger retail investors boom. Since then, shares have had a tough ride. The story last year was weaker trading activity amid economic uncertainty and restrictive central bank policy. Since then, there has been a push to branch out and diversify revenue streams. The company beat the street with its first quarter earnings, but the big announcement, a 24-hour trading platform 5 days a week. It launches next week. And here to tell us more, Robinhood CEO Vlad Tenev. Vlad, I am delighted to welcome you back to Yahoo Finance. It has been too long, and it's really a pleasure to have you with us. And indeed, this push that you guys have been doing to diversify your revenue streams, it did seem to pay off, particularly in the first quarter. So talk to us about this diversification, what the business looks like now, and what investors need to know.
Yeah, absolutely. I've been incredibly proud of the work that we've done to diversify the business. You know, before you had mentioned Robinhood did quite well in a zero rate environment. So the question was, can we adapt to a high interest rate environment? And when rates started their rapid rise last year, we saw opportunities for our customers. We doubled down on improving the customer experience for our more active traders. And we also rolled out products like Robinhood Retirement, which is the first IRA with a built-in 1% match, as well as Robinhood Gold, which gives customers 4.65% APY and up to $2 million in FDIC insurance. So customer behavior certainly has changed, but I think we've been doing an amazing job just giving customers the things that give them the most possible value given the current market environment. 24/5 is another example of not just giving a product that active traders really value and allows them to manage their risk better, but it's us pushing the industry forward and innovating in the same way that we did by launching zero commissions and no account minimums, the same way we did by launching fractional shares trading, and of course with the recent gold and retirement offerings. So trading should be round the clock. It should be untethered from U.S. East Coast working hours. And I think this moves it a step forward and really closer to what it should be, which is technology rather than some brick and mortar legacy institution.
Vlad, Brian here. Good to see you here back on Yahoo Finance. Do you think these initiatives will help attract the next generation of investors?
I think we've always been focused on the next generation of investors. I think for 24-hour market in particular, there's two things that two groups of people is very useful for. One is active traders who want to be able to react to breaking news no matter what time it arises and manage their risk. Also, I think it's very useful. You may have noticed on the earnings call that we've been talking more and more about how we're expanding internationally. A big part of our mission is making our services available to people outside of the US who in some cases are even more underserved than American consumers. And the experience of investing is more difficult overseas where there's very little overlap with sort of wake hours. So I think this sets us up well to serve those customers and provide them a native experience, much like those in the US get.
A product feature like this doesn't roll out unless there is a significant kind of additive or net benefit, right, Vlad? So what type of revenue additive do you foresee 24-hour trading giving Robinhood or providing to the business?
Well, I think clearly we think that this is going to lead to increased volumes, but perhaps the most important thing is just increased customer satisfaction. If you look at active trader net promoter score, that's up 30 points year over year. So our active traders are very, very happy, even in the face of kind of the challenging macro environment. Overall customer NPS is up 20 points year over year as well. And we believe if we keep innovating and keep our customers happy, no matter what the macro conditions, then it's all a part of deepening our relationships with our customers even further. And 24-hour market is sort of certainly a component of that.
Vlad, in reading through your conference call and your earnings statement, I've been trying to wrap my head around the different ways that you guys make money, back to this sort of diversification idea. You're not a bank, right? When people deposit money with you guys, it's custodied elsewhere, is my understanding. But you do make interest income on those assets. How does that work? Do you pay a fee to the bank and then you can invest that money and collect interest income? Like, what's the sort of mechanism there?
So there's a couple of different products that come into play here. You might be talking about the Robinhood Gold offering, where customers get 4.65% APY on their cash and $2 million in FDIC insurance. So that's actually, it's a really interesting type of product. It's called the bank sweep product. So what happens is we sweep customer cash to a network of up to 8 banks. Starting June 1st, the number will go up to 8, which gets you the $2 million of FDIC insurance per customer. And what happens is those banks give the customer the high rate and they give us a rebate. If you look at the 4.65% APY right now, it is an incredibly competitive rate. It's hard to beat. But part of the reason for that is the Fed has raised the Fed funds rate to north of 5%. So there's just more interest income to be had, and we're passing a very large portion of that to our Gold customers.
At some point, are you interested in getting a bank charter, or is that not in the cards or in the plan for Robinhood?
You know, it's something we'd considered in the past. And when we looked at the kind of products that we want to offer, we actually found that not having a bank charter allows us to do the same sorts of things, offer the same value to customers, and gives us much more flexibility. For example, if we had a bank charter, we would be limited in our bank account to offering $250,000 of FDIC insurance to customers, which is a large number for most people. But you know, having $2 million of protection, especially in the current environment where we've been seeing the regional banking stress, I think is a huge differentiator and should give customers that added sense of security in the safety of their funds on Robinhood.
Vlad, last August, you made a tough decision, I imagine, for you and the team to part ways with about 23% of the staff. But since then, you've really come out with a host of new products. The product pipeline, based on a lot of people that I have talked to, very robust. Has that move allowed the company to move faster, and are you happy with the size of the team now?
It has, actually. I think that, frankly, in 2020 and 2021, when we were dealing with just extreme growth in the face of the pandemic and low interest rates, we hired a lot of people, and the focus was on just meeting kind of immediate needs and ramping up customer support. And I think there's a sacrifice when you take that on, and the transition to having a leaner operating model, to being scrappier, to doing more with less. It was a painful transition, but you can see with the product velocity, and not only the products we're shipping, but several products that we shipped last year, adding considerable revenue to the business, that the business has been much stronger as a result of some of the changes and improvements that we've made.
Robin, excuse me, Vlad, to slip up there. Vlad, we know that you've talked about with the business how important, even when you were going public, how important crypto was to the growth of Robinhood here. And, even as we think about the banking turbulence that took place that you talked about on the conference call, I wonder if there was kind of a quantifiable view or volume of how many users on the platform did decide to tap into crypto, knowing that we saw the correlation, at least the time correlation, in the price action of crypto with some of the regional banking failures that took place.
You're asking whether during the regional banking failure, there was a spike in crypto activity?
Certainly, and if there's any way that you could quantify it, and how long those users typically stay engaged with the crypto products on the platform.
Yeah, crypto activity has been overall moderating from the highs in 2021 and kind of early 2022. The market did see a little bit of an increase in the past couple of months. And some people do view Bitcoin as an inflation hedge, much like gold. And I think that thesis hasn't really had the opportunity to be proved out, because Bitcoin was created in the late 2000s, and it's mainly operated in a high interest rate, low inflation environment. So I think it's a little bit early to actually definitively say that thesis holds, but I think it makes a lot of sense, and you see a lot of customers turning to it as a long-term investment and not just a speculative short-term trade.
Vlad, one of the things that your CFO talked about on the call, even as you guys have been, like many companies, retrenching, right, cutting back, you're not ruling out deploying capital in various ways. One of those ways may be M&A. What would be the kinds of opportunities you would be looking to add on to the business?
Yeah, as Jason mentioned, and as we talked about, we have a strong balance sheet, and that gives us the opportunity to be strategic and to take advantage of opportunities that arise. And it's both investing heavily in new product development, as we have been, and lots of companies right now are really focused on not launching new products as we have been, but kind of maintaining and not losing too much. We've been able to be aggressive on that front. And on the M&A front, look, we're always on the lookout for opportunities. We want to be extremely prudent. And I think historically, Robinhood has been a company that relied on kind of internal folks for our innovation engine and for rolling out new products. And we've built a large portion of the infrastructure that powers these innovative products in-house. But that said, if we see opportunities out in the market to buttress that and to bring in capabilities that could accelerate what we're doing, we're always on the lookout for that.
I want to ask you about the firm's relationship and really the industry's relationship with regulators, because there was a report this week, or actually it wasn't a report, you guys said regulators are looking into record keeping at Robinhood, and this is something they'd looked at with the banks as well. And of course, I think it's safe to say Robinhood, some of your peers as well, have been under a lot of scrutiny from regulators since inception. Do you think that what they're doing is indeed helping investors? Do you think you've been unfairly targeted? Talk to me about that give and take.
I think as a company that's innovating and taken a leadership position in our space, we're subject to scrutiny, as any big company should be. And our focus has always been on putting regulatory compliance front and center, maintaining great relationships with our regulators, and sort of keeping them along the journey. So I don't think that that it's anything new. And of course, we're continuing to push hard to innovate in the environment and keep our regulators along and informed as we do so.
Following the retail trading frenzy that ensued during 2021, early 2021, that led to some halts in specific symbols during that time, you also called on the regulators to make specific changes ranging, but one of them was on settlement times and clearance. Have the changes that have been put forth by the SEC to this point, have they been adequate enough for how your platform operates and what the end users expect of the experience?
Yeah, it's traditionally been a slow-moving industry with a lot of legacy infrastructure, right? As we were talking about earlier, 24/5 trading is an example of that, as is the settlement system. I mean, in the past 30 years, the trading hours haven't changed or been updated once. And in that time period, markets went completely electronic. And I think we have a large part to play in pushing that forward. With settlement, as you mentioned, I did call for real-time settlement, and the industry is moving forward with T+1, which is not quite real time, but it kind of shaves the settlement time in half. And I think some of these things for us might seem like not enough, but you got to remember most of these companies are operating on mainframes and legacy infrastructure still. So making these types of changes does take time. And I think that's why things like 24/5, to go from me talking about it to us announcing and shipping something to customers within a year, it's actually, we're very proud of the team for the work that they've done in making that happen.
Certainly. There have been a lot of trading platforms that have done very well as a standalone company, and some of them for decades. Some of them have later on had to consolidate into some larger banks. For Robinhood, is it a future that you foresee that you want the company to march forward as a standalone company, or does the next leg of growth from your perspective look stronger or look more attainable if there is a combination with another entity out there?
Well, if you look at what drove some of the consolidation that you're talking about, it was really the sort of entrance of Robinhood in the market that caused commissions to go to zero. So when we came in and started offering zero commissions, for a while, kind of the legacy brokers were ignoring that as a threat. And then in 2019, all of them simultaneously saw that materializing, saw us taking more and more market share. That led to them dropping commissions, and they had to consolidate to make the business model work at that point. I think for Robinhood, starting from the ground up, from kind of the founding of the company as a technology company rather than brick and mortar, has allowed us to stay lean and continue to innovate and drive the industry forward. And with the financial results that we announced, you saw adjusted EBITDA increasing sequentially, revenue increasing significantly year over year. And that gives us a lot of confidence that not just in a great market environment, but also in kind of the difficult market environment that we're in, Robinhood is continuing to thrive.
Vlad, awesome conversation. Thank you so much for spending so much time with us. Really appreciate it. Robinhood CEO Vlad Tenev and our executive editor Brian Sozzi. Thanks.
Thanks, guys.
Coming up, the rail industry faced a renewed push for safety crackdowns following the Norfolk Southern derailment in Ohio. How is the company faring now and addressing it? We're going to hear from the CEO next. Let's do a quick check of the markets now, sponsored by Flex Shares. We've got a mixed picture at the moment, with the Dow trading higher by about 0.1%, but the S&P and the Nasdaq losing steam. I can say it's not because of our top trading ticker on the Yahoo Finance platform. That's Tesla, and that's trading higher. So that doesn't seem to be hurting the Nasdaq in today's session. But we are seeing a little bit of wavering to end the week. Saz?
Thanks, Julie. Norfolk Southern has faced a challenging few months after train derailments in East Palestine, Ohio, released millions of gallons of hazardous materials, leading to a rail safety bill from the Senate and $387 million in costs for Norfolk Southern. Alan Shaw, Norfolk Southern CEO, joins me now. Alan, good to see you. I know this was a long time in the making. Appreciate you joining us.
Yeah, I appreciate the opportunity. You know, we were scheduled to get together in February. I really wanted to be here, but I needed to be in East Palestine. Yeah, so thanks for your flexibility.
Of course, we appreciate that. So I think a lot of questions from investors regarding where the state of the company is. But first and foremost, why are these derailments happening? Another one this week. Why are investors seeing this?
You know, I think it's important to note that rail is the safest, most sustainable, and most efficient form of transporting goods across land. We can do better. Right, and last year at Norfolk Southern, our number of derailments was the lowest in 2 decades. We can do better. We're looking at this stuff. We're working very closely with the NTSB, and you've seen me on the Hill advocating with Democrats and Republicans for additional safety measures. And you look at just the East Palestine derailment, it's going to require an industry response, and here's why. The NS crew is doing exactly what they were supposed to do. There were no track defects. The wayside detectors were working, and the NTSB is looking at a rail car that no railroad owns and touched 3 railroads before it got to Norfolk Southern. So it's going to require an industry-wide response. I understand my role there, and I'm embracing that role and taking an industry-leading position in advancing safety in rail.
So is it an equipment thing? Is it the trains you are running? Is it a process thing? Why does this continue to happen?
You know, what we saw in East Palestine is the NTSB is looking at a catastrophic failure in a wheel bearing on a car that is owned by one of our customers.
What is the presence on the ground now for you in East Palestine?
You know, we've got 300 people, NS employees and contractors, who are there 7 days of work, working on the environmental remediation, working on community assistance, and helping invest in the community to help it thrive. And I really appreciate what they're doing. Well, here's what I see, Brian, is when they come home and take some time off, they want to get back up to East Palestine. And I've heard reports of people cutting vacations short. And that tells me two things. That tells me the NS team knows that they're having a positive impact on the community. And that tells me the community is giving our team a lot of positive reinforcement. You know, I was there in the immediate aftermath. I've been there almost every week since. And I'm taking it as an opportunity to sit down with the community, find out what we're doing well and what we can do better to help the community thrive and monitor our work.
How long do you plan to be there?
We're going to be there as long as it takes. You know, we're not going to be bounded by time or money. Each and every day, we're going to do the next right thing, and I'm going to see this thing through, no matter how long it takes or no matter what happens.
I think one of the questions is, and it's not just a Norfolk Southern thing, it is the railroad industry that's moved to precision railroading, and that is something that I came in contact with by Hunter Harrison, legendary railroad figure. Now, this is something you guys have adopted. Are you committed to staying that route, given the concerns about longer trains and speeds?
You know, Brian, I became CEO about a year ago. And in my first year as CEO of Norfolk Southern, I was really proud to announce a new strategy and chart a new course within the industry. There are some components of PSR that we're going to continue to endorse, and that's developing our people, working safely, you know, investing in our assets. We are now focused on long-term growth, and we got a vision for doing the right things over the long term for our customers, our employees, the communities we serve, and our shareholders. Since I became CEO about a year ago, we've been on a hiring spree, which is different from what you've seen in the past in the rail industry. And right now, the number of employees at Norfolk Southern is 1,500 higher than it was a year ago. And our pipeline of conductor trainees is amongst the highest on record. And I can do that because of the confidence I've got in the strength of our powerful franchise, the customers we serve, and the markets we serve. We're focused on long-term growth.
Is PSR still viable for the industry?
Norfolk Southern has a different strategy. We charted a new course, and we're going to deliver on it. And it was working. You know, our customers saw it. You look at our service levels in December and in January, they were at the highest they've been in a couple of years, and our volumes were outperforming normal seasonality.
So it's a hybrid system?
Yes. Yeah.
So what does that mean? Do you run shorter trains than competitors? How does it work?
We invest in resiliency, right? We take a long-term view of things. And there are a lot of secular trends that were accelerated by the pandemic that really support growth on Norfolk Southern. We see a lot of onshoring. We see forward positioning of inventory next to the ultimate consumer, right? We see more manufacturing in the United States. And when you look at our franchise, and this is why I'm so confident in what we're doing, we serve 60% of the consumption in the United States. We serve more than half the manufacturing. We serve more than half of all U.S. vehicle production. Every day we ship 8,000 vehicles. And we serve more than half of the energy consumption in the United States. So that gives us the confidence to invest in the long term. And we've got, as you know, because you covered the space, the most powerful intermodal franchise in the East that serves the U.S. customer. So we've got a powerful franchise that faces the fastest growing segments of the U.S. economy. I fully intend to leverage that by engaging with our people, hiring people, and investing over the long term.
We recently caught up with Transportation Secretary Pete Buttigieg. You mentioned regulators. Take a listen to what he had to say. I would love for you to get a reaction.
Look, we have a lot of concerns about the business models that the railroads have adopted. They strip out the human factor. Employment at some of these major railroads is down 30%, 40%. They've become wildly profitable, but have not been able to dramatically improve their efficiency or their fluidity in moving goods. And it's really come on the backs of workers who are now overworked, stressed out. And this is part of what led to so much concern last year as as workers were insisting on sick leave, something that we still believe these railroads need to provide. Some of them have negotiated it with some of their unions, but they should all be doing more right now. We're also concerned about railroad safety.
Now, your reaction to that, and Buttigieg, he also advocated for approved braking systems. Do you want to see that?
So I've been engaged with the Secretary on a number of occasions. We've had a lot of constructive dialogue, and I continue to engage with him. I respect his opinion. There are a lot of things that Norfolk Southern does that are absolutely aligned with the administration's goals. High-paying union jobs. I told you the hiring spree that we're on. Investments in the nation's infrastructure. Pulling trucks off the highway, and the sustainability advantage of rail relative to truck. So we're aligned on that. Relative to our long-term focus and our pivot away from that traditional rail model and hiring, that's exactly what we're doing. As I talked about, the new strategy Norfolk Southern charted in the industry. And then relative to rail safety, I've been on the Hill a number of times. I'm advocating with Republicans and Democrats for many of the provisions that are included in the rail safety bills.
Is braking part of that one?
ECP brakes, I think, is what you're referring to. You know, we tested that. We were one of the first testers of it about 15 years ago, and we couldn't get it to work reliably for us.
Lastly, real quick, what removes the regulatory overhang on your stock?
You know, I think what is important for folks to know is there are a lot of things in these bills that make sense, and they will not create an undue burden on our cost structure or the cost structure of our customers. And as I engage with the Surface Transportation Board, you know, I'm very close to them as well. What they're really looking for from me and from the rail industry is my ability to execute on that unique strategic plan that we outlined last fall that's going to drive service and drive growth.
All right, we'll leave it there for now. Thank you for doing this. I know this is a very busy time for you and your company. We appreciate the time. Thank you so much. Norfolk Southern CEO Alan Shaw.
Brian, my pleasure.
All right, coming up, regional banks are mixed to end the week, but is the worst of the banking crisis over? We'll find out next.
The most recent gauges of inflation, both producer and consumer, showed prices slowed slightly. Price increases slowed slightly in April. The consumer price index falling to 4.9%, a tenth of a percent cooler than analysts expected. One Fed official, though, not satisfied with that report, saying there may be a need for more rate hikes if inflation does not come down further. For more on this, we go to Yahoo Finance's Jennifer Schonberger for those remarks. Hi, Jen. Good morning.
Good Friday morning to you, Julie. That's right. Fed Governor Michelle Bowman saying this morning that if inflation remains high and the job market remains strong, more interest rate hikes would be needed. Speaking earlier this morning at a conference in Frankfurt, Germany, Bowman said, quote, should inflation remain high and the labor market remain tight, additional monetary policy tightening will likely be appropriate. She went on to say, right now, inflation remains much too high, and measures of core inflation have remained persistently elevated with declining unemployment and ongoing wage growth. Bowman says the latest read on consumer prices via the Consumer Price Index, as well as the latest employment report for April, haven't convinced her that inflation is dropping. While the headline read on CPI cooled to 4.9%, the so-called core reading, which the Fed favors because it excludes the volatile food and energy prices, remains sticky at 5.5%, about in line with the core level on inflation so far this year. Though Bowman says the economic outlook is uncertain and monetary policy is not on a preset course in light of the recent bank failures, underscoring that credit conditions continue to tighten. Bowman also weighed in on the recent bank failures, saying some banks have followed a ask for forgiveness, not permission mentality, and that banks must prioritize a strong risk management culture. She said if banks can't take supervisors' directions to correct problems informally, then regulators would need to impose formal measures with definitive timelines and consequences for banks that fail to correct issues in a timely way. Bowman says she's also extremely concerned about calls for scrapping tailoring capital requirements based on banks' sizes, something that Fed Vice Chair of Supervision Michael Barr has indicated needs to be revisited. She warned imposing higher capital requirements could increase funding costs for banks, saying, quote, if it ain't broke, don't fix it. Julie?
All right, I'll take it from here. Thanks so much, Yahoo Finance's own Jennifer Schonberger. Appreciate it. Sets up our next conversation, a mixed picture for shares of regional banks as we close another tumultuous week here. PacWest trading higher today after plummeting on Thursday after the lender revealed deposits fell 9.5% in the prior week. This comes after reports that the bank is exploring a potential sale. So let's dive into the state of regionals with Dylan Ratigan, host of Truth or Skepticism on Tasty Trade. Dylan, great to have you back here on the program with us. So what we've heard is that much of the crisis is over or behind us. But I mean, this week, the numbers tell us something different from some of the latest culprits involved in this PacWest. And then additionally, you're hearing from Western Alliance over the course of this week, too.
Yeah, I think the big difference, though, now is that everybody has taken as truth that in the most extreme circumstance, they will be given forgiveness, to use the phrasing of your last reporter. And so, you know, the threat of people losing their deposits does not feel present anymore, for instance. In other words, the implication is that all deposits are insured. And so it's become someone else's problem. It's become a rich person's problem, stockholder, bondholder, but it's no longer an argument about deposits. And I think that that is a significant shift from where we were earlier this year psychologically, which is both good for people and business and ultimately those banks, because it reduces the pressure to remove assets.
I'm interested in as well in sort of the flow of deposits that we have seen over the past few months. I mean, I know that's something that you're watching too. We just talked to the Robinhood CEO, for example, and it looks like that company got some money flowing into it as this was all. Yeah, it's really interesting, right? This dynamic here. How do you think that shakes out?
Well, I think ultimately it makes fintech companies more valuable and legacy finance institutions less valuable as a multiple and as an institution, because banking as a general category, as you well know, Julie, makes a lot of its money based on the friction or the changing burden. In the industry, they would call it the stickiness of the customer. And it's easier for me to change, I don't know, which sneakers I buy at a Foot Locker from Adidas to Nike than it is for me to change my bank accounts or my mortgage or my brokerage accounts or these types of things. And so even in the face of neglect or bad service, the banks at the end of the day, like the cable company, they collect their rent. And the more the fintechs, whether it's Robinhood or Tasty is another one, where I've been working for the last 10 years with Tom Sosnoff, and what they've done is a tech first move on a belief that financial customers will become less and less sticky, which is good for old and new if you have good product, but it's terrible if you're in the middle and your primary value proposition is I have customer loyalty, I have customer stickiness because I'm First Republic or because I'm Silicon Valley or because I'm the Bank of Texas or whatever that I do all the vineyards, whatever the bank's narrative is becomes much less valuable. And I think that's part of why you're seeing all these stocks compress even after there's implicit, if not explicit, deposit insurance.
So with all of this considered, is there any additional action that the government, federal government, or regulators should be taking at this point in time to shore up banks?
I mean, the number one action that they need to take is they need to reattach management's decision-making to the amount of risk. So a bank CEO's job is ultimately sales and risk management. And everything else that the bank does, someone else is doing. And then the CEO theoretically works with the board on risk management, meaning how much resources were we going to risk on this type of lending? How much for these startups? How much for foreign bond markets? How much for domestic technology stocks? How much for home mortgages? That's what the CEO's decision. That's what the CEO's job is. And when you see these banks fail in this way, because it's always because of excess risk taking, right? Whether it's in the leverage of the lending book 10 years ago, or whether it's in the idiocy of the duration structure of the bond portfolio into this, rising rate structure. Either way, the only way to regulate a financial institution is to create an incentive for the manager not to make dumb decisions. And the current bank regulatory apparatus incentivizes the opposite. It says take the dumber the risk, the better, because you can collect short-term income in your bonus while you're in the middle of that risk-taking architecture. And at the end, if it blows up, someone else is holding the bag, whether it's the shareholder, the bondholder, or the taxpayer. And so that's what, that's why I get alarmed when you hear the Federal Reserve talking about, oh, well, we don't want to adjust capital. They like leverage. Everybody likes leverage. That was a central banker said, why are you going to mess with the leverage for the big banks? But that's where bank regulation lives.
Yeah, well, even when they do regulate and incentivize away from risk, they find new ways to take risks, Dylan, as you well know.
Which is why the partnership, Julie, was the best model going back, not to go old-timey, but you go back to 1975, and if you were going to take the risk, it was a Salomon Brothers risk, or it was a Smith Barney. And so you go home at night, you're like, I don't know if I want to give Julie this crazy loan. But if it's someone else's money, I'm like, yeah, give Julie all the money she wants.
Sure, why not?
I'll take the fee. Anyway, that's a philosophical discussion.
It is a longer one to be had another time. Dylan Ratigan, great to catch up with you. Talk to you soon.
All right, bye.
Thanks. Coming up, from banks to food, we've had some great conversations all week on the state of the consumer. We'll give you a pulse check next.
So far right now, the customers is really hanging in there, but we're obviously watching what everybody else is too.
We sold more large hamburgers than we have in the last 6+ years, at a time when we have a trade up from 4 for $4 into a $5 biggie bag into a $6 biggie bag. So we feel like we got a good menu construct to bring folks in for one more visit, drive one more dollar that works for the consumer.
We have pricing power, but we're really thoughtful about it. We want to always remain a sweet, indulgent treat that's affordable.
We haven't seen much pushback. In fact, our loyal customers at the top end of our traffic, they've stayed with us. Those numbers have really been pretty even across the board. If anything, we've seen some pullback in maybe some of the less frequent shopper as we've kind of evaluated what's happened so far in 23.
Americans have always grilled, and food is becoming more important to Americans. So there's a long-term trend around food as an experience and around backyard cooking.
So we just heard from various executives, from Chili's to burgers and Wendy's to donuts to grilling in your backyard. And really the theme across all of them, in their view, is that the consumer remains relatively resilient. But then on the other hand, we got that latest data this morning from the University of Michigan, the Consumer Confidence Survey, showing a weakening there and a concern about the economy, a concern about the debt ceiling as well, and what effect that's going to have on confidence going forward. As we know, there is always never a perfect match between how consumers feel and what they say and what they do.
Right.
But nonetheless, it is an interesting dichotomy right now.
Yeah, and where they're focusing so much of the spending on food and how they're spending on food particularly is coming to light over the course of this week too, whether that is going into the restaurants, and you heard from a restaurant CEO there as we had our Chili's conversation earlier on this week, and then even into kind of taking the experience into your own hands on the grilling front there too, which is a video that I'm going to send to my building's management to make sure that they keep the grills open all year round. It's a travesty that they close them for 6 months out of the year. But all that aside, I think consumers are still looking for a way to hedge against, or at least combat against, where they are paying higher prices to kind of either pick and choose which food experiences they go into, and making sure that they're still getting the value for the dollar spent as well, which is actually what we heard from Brinker this week as well.
I'm just picturing you on the roof or the balcony or wherever you are in your building.
Nice patio.
In your parka.
I would do it.
At your grill.
I would be in a parka on the grill in December if they gave me the opportunity.
You know what? I think this is a perfect segue into our next guest.
It is, indeed. Solo Brands is lighting up the direct-to-consumer space with its acquisition of TerraFlame as it looks to build out its relationship with retailers. Solo Brands CEO John Maris joins us now. John, you just heard my tirade on my building not keeping the grills open for long enough. So I'm just not allowed to purchase one of these and have it just propped up on the ceiling or the balcony or anything like that in its absence. So anyway, take us into this latest deal that you've struck, because you've got a host of companies within your portfolio. Why did this one make sense?
Listen, we're solving that problem for you. And that's actually, that was a perfect segue because this TerraFlame acquisition actually allows Solo Stove to go inside. So imagine being able to do s'mores in your kitchen. That's exactly what it's designed for, whether it's just for a year-round flame opportunity. It doesn't matter how hot or how cold it is, but also in urban areas like New York or Chicago, where you can take this clean burning fuel source inside. You can have s'more night with your friends and family members. Make those great memories around the fire, even indoors. So we're super excited about the opportunity to bring TerraFlame into the Solo Brands family.
I love that, a year-round flame opportunity. So talk to me more broadly, right? Because what we are seeing in this business that, aside from TerraFlame, your business is mostly catered to outdoor activities, right? Whether it be running around in your shorts, whether it be kayaking, whether it be sitting in your backyard around a Solo Stove, or now maybe inside around TerraFlame. Most of it is geared towards outdoor leisure, right? Which we have seen people buy a lot of this during the pandemic and then not as much more recently. So where are we cadence-wise right now?
Yeah, so I think two things. One is just remember that nobody's interested in going back to the pandemic and being pent up inside. So this renaissance towards the outdoors has not slowed down. What happened during the pandemic is a pull forward. So people that maybe were interested and had been on the fence pulled forward during COVID. And so the demand doesn't look as high, but it's really just that there's a slowdown because of this pull forward. So we see things leveling out right now and getting right back to a normal growth rate. You've seen the growth last year that we put up in 2022. In spite of a pretty interesting environment, we still grew over 20% last year, and then in Q1 delivering growth again. So we think we're at a stabilized place now, and we're seeing consumers, and you guys were talking about it just a few minutes ago, but the state of the consumer right now is not one that says we don't want to have experiences, we're going to stay inside, we're not willing to invest in experiences. It's actually the latter, and nobody really wants to go back to staring at screens all the time. And so in this environment, it's interesting because travel somebody said yesterday, I love this term, but somebody said, there's a period post-COVID where there was revenge travel happening. It was like, I don't care how much it costs, I'm going to travel because I haven't been able to. And I think revenge travel has slowed down, and now people are looking for ways that they can prudently spend and invest in experiences, and Solo Brands becomes an obvious choice to be able to do those things.
Yeah, amen to not going back and forth, back just in front of the screen, John. I want to ask you a similar question to what I asked the Traeger CEO, even though obviously you have a more diversified business across the various outdoor leisure activities. What does that more normalized pace of growth look like? You said last year was in double digits, 20%, first quarter net sales up 7.3%. Is the 7.3% what a more normal long-term growth trajectory looks like?
So we have some cyclicality quarter to quarter because of seasonality, right? So Q2 and Q4 for us are bigger quarters. Q1 and Q3 are a little bit slower. It's right around the middle of that. So what we've guided towards is a long-term growth rate of around 10%. And that's what we think is a good normalized growth rate to expect to move from in this post-COVID environment. So 10% long-term growth is, I think, where we're going to see things settle out.
Take us into some of the other brands as well here. I mean, I remember when Chubbies were really popping off, and I think it was about 2012, 2013. It was getting a lot of fanfare. Everybody was like, all right, the short shorts, the hoochie daddy shorts, as some of them might call it out there. It's having a moment, I guess, here. So what does that look like? What do the future prospects now look like for Chubbies? What kind of demand are you seeing there?
It's exciting, and you're spot on. It started off as a younger customer demographic. Obviously, if we go back to 2012, 2013, 2014 and beyond, that younger customer base is now growing up a little bit. They're maybe having children. So we've launched Family Swim, which is, the ability to match your trunks to your kids, which is a pretty big trend right now. But also last year and the year and a half, you've seen Chubbies do a lot of innovation around athleisure wear. So golf shirts, longs, I like to call them pants. We launched pants, but I say we have shorts and we have longs. I'm wearing a pair right now. Beautiful, stretchy pant that you can dress up or dress down. You can tuck in or tuck out with outerwear. So getting into warmer weather months. But we're showing the ability to keep that customer engaged that was younger back in the mid-teens and getting them back and continuing to be able to offer products and apparel that they're excited to wear. So we've still got that loyal customer base. We're continuing to innovate around what that customer wants and seeing really, really nice growth in the Chubbies brand.
Let's round this conversation out. Just a lot of fanfare within our own internal Slack channel about the kayak business too. Everybody wants a kayak in New York. We're not sure where we're going to take it. It's pretty hard to get it on a subway too to ultimately get to your destination. So all of those challenges considered, where are the hot markets right now? Where among the consumer demographic are you seeing the most pickup too?
Believe it or not, it's actually in urban areas. Oru Kayak was founded in the Bay Area in San Francisco by an architect who loved to kayak but couldn't get his kayak in his Bay Area apartment. He wanted to be out on the water, so he figured out how to fold a rigid material that would unfold and basically create a rigid kayak, but weigh a small enough weight that you can make it portable. You can take this kayak, you fold it into a box. The box is the kayak. It weighs 20 pounds. It fits in the back of a Prius, a taxi cab, whatever it might be, and allows you to enjoy water recreation, even if you live in the city. Chicago obviously has tons of waterways. There's plenty of water in and around New York, San Francisco. And so those are areas that are our hottest. The innovation around that brand right now is super exciting. They actually just yesterday launched Oru Outdoor. So Oru Kayak has shifted to Oru Outdoors. and they launched a series of outdoor camping furniture that uses that same origami technology so that you can unfold chairs, you can unfold tables that are super lightweight and portable.
I think you've sold Brad and I, John.
Yeah, we're into it, John.
The folding kayak.
Should
we go in on this together?
I mean, we still can't take it out in the Hudson River, John. I mean, it's just not safe. We'd have to like flex seal it afterwards.
Take it to Coney Island.
Sure, it's great. Coney Island, yeah. That might work. John Maris, Solar Brand CEO, thanks so much for joining us today. Really exciting to talk about the business.
Yeah, thank you, guys.
Absolutely. Everyone, let's get a quick check of the markets here as we round out today's show. This market check sponsored by Flex Shares. Taking a look at the Dow Jones Industrial Average, it's down by about 0.1%. Fractional moves lower for the S&P 500 and the Nasdaq as well. The Nasdaq down by about 0.4%, 42, 43-ish points to the downside right now, Julie.
All right, let's leave you on this Friday with the top 3 things coming up on Yahoo Finance Live. First up, a change at the top. Musk announced he will be stepping down as Twitter CEO. Multiple reports say NBCU's Linda Yaccarino will take the helm. CNBC also reporting she has now resigned. Is this the start of Twitter becoming more of a media company? We'll see. Rochelle Akupo is going to dive into it next.
And later, debt ceiling drama. But what does Washington's problems mean for your mortgage rates? We're going to narrow in on the impact inside the housing sector.
Plus, Nobel Prize-winning economist Paul Krugman warns that the risk of debt default is real. He's going to be joining our 3 to 5 p.m. show and weigh in on the risks. Many voices echoing that sentiment. You don't want to miss that interview. Rochelle's got you for the next hour of trading. Have a great weekend, everybody. We'll be back Monday.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. NBC's ad sales chief quits as reports swirl over her being tapped as Twitter's next CEO. Advertising traditionally drives the lion's share of revenue at the company, so is this the right kind of move? We'll get into that discussion. Had no debt ceiling talks today, but the debate rolls on. President Biden and House Speaker now meeting early next week. This kind of uncertainty can't be good for anyone, right? Well, we ask an expert if there's a real risk of default. And the EV price war rumbles on. Tesla boosts prices in the United States again. So is this really a troubled picture for the sector? The IEA doesn't think so. We'll find out what climate expert David Calloway thinks. You won't want to miss that. But first, let's take a look at how the major indices are faring. We see all three in some selling action here. The Dow now off about 33 points, about 0.1%. The S&P 500 also down. We're seeing that driven down sector-wise in terms of consumer discretionary after that consumer sentiment data came out. Also taking a look at the Nasdaq. FANG stocks under pressure, except for Google, after it stepped up its AI game versus Microsoft at its latest Google I/O announcements. Let's also check in on the Treasury market then, see how some of those are faring. Looking at something of a flight to... We were looking at a flight to safety yesterday. Different case today, though. We're looking at the 5-year in positive territory, up 1.8%. The 10-year up over 1% as well. And the longer-term 30-year yields up 0.4%. Well, Elon Musk says he's passing the baton to a new CEO at the social networking site. Musk tweeting the new leader will start in 6 weeks. He adds he'll stay on as executive chairman and chief technology officer. So who's the new boss of the checkmarks? NBC Universal advertising head Linda Yaccarino is reportedly in talks to take over. That was first reported by the Wall Street Journal. Now, she resigned from NBCU today. For more on this, we turn to Yahoo Finance's Ali Garfinkel. Ali, we knew that Musk was stepping down, but now we actually know that this is a done deal here. He's made a hire.
He's made a hire, but it's important to say off the bat here, Rochelle, that this is not fully confirmed. I think I've sent out dozens of emails and calls trying to confirm, and I know I'm not the only one. That said, things are lining up here, right? This does make sense, right? Yaccarino, for example, is a TV ad sales veteran. She has been at NBCU for 11 years. And reportedly, she's even been in touch with Musk in recent weeks. For example, she reportedly interviewed him at a panel recently that was communicating with advertisers. So, as with everything with Musk, before anything is confirmed, before there are any official announcements, we should take this all with a little bit of a grain of salt for now. I would like to remind you that Musk in April did say that the new Twitter CEO would be his dog. So it's important to say this isn't confirmed. However, it is lining up. It's also at a moment where faces are really changing for Twitter. For example, Tucker Carlson, who recently left Fox News, is going to start a new show on Twitter. What this looks like is still unclear, but it's clear that it will involve some kind of direct-to-consumer business. Additionally, Musk has reached out to former CNN anchor Don Lemon, asking if he's interested in doing the same. What's most interesting to me here, Rochelle, is these are not social media names that Musk is most interested in, it seems like. These are legacy media names.
And to that point then, does it seem as if Twitter is now becoming a media company? When you think of how it's evolved from when he first took it on to now sort of making these incremental steps to almost make it a media / that X everything app that he's been talking about?
It's a good question, Rochelle, and that's certainly what people are saying. And I think the hire of Yaccarino certainly takes it further in that direction, right? Last year, she did lead this doubling of advertising commitments at Peacock. So she is really specialized in these legacy media companies and what it takes to sell ads at them. So it makes sense that it's perhaps Twitter would take on some of the features of a legacy media company. That said, one of the key problems for Twitter over the last few months has been that advertisers have been leaving in droves. So the goal would be that Yaccarino is someone who could bring those advertisers back. Dan Ives on our show earlier today called her a home run hire. So it's the sort of thing that the names that are being bandied around, if it is in fact Linda Yaccarino who takes on as CEO of Twitter, it does make sense that Twitter will become more legacy media-like. And though there are a lot of key differences between social media and legacy media, I think one of the important things to know is that there is a key similarity, which is that ads matter, and ads matter a lot. They are revenue driving, and if you're not selling ads at a legacy media company or on social media, you have a problem.
It's true. I mean, clearly the sands are shifting here and Musk clearly getting ahead of it at the moment. Great stuff there. Thank you for that update. Ali Gonfinkel there for us. Right, now to monetary policy. If this week's inflation data is any indication, the end of rate hikes may be within sight. The Consumer Price Index, a key inflation gauge, up 4.9% from a year ago, just a touch lower than March's 5% figure. Now, of course, you also have the Producer Price Index, which the Fed prefers. That rose 2.3% on an annual basis, below estimates and the slowest annual increase since January. And of course, markets pricing in an 84.7% chance of a pause in June as of this morning, and that's down slightly from the prior day. With 1 month to go until the Fed's next meeting, our next guest is keeping bullish in the near term, raising his target on the S&P 500. Barry Bannister is the chief equity strategist at Stifel, and he joins us now. Apologies there. We're going to be focusing on the consumer. David Waddell joining us now. Thank you so much.
I can be Barry if it makes it easy.
No, David, we're happy that you're on. We want to first talk about the state of the consumer. You have this, this number that really shocked in terms of the Michigan sentiment here. And considering that consumer spending makes up 2/3 of the US GDP, I mean, where are we now then in the conversation about how the consumer is actually faring?
Well, we have to remember the Michigan Sentiment Index really only surveys like a few hundred people. So I'm not sure it has the teeth that some think it may have. Maybe did drive the dollar up a little bit and interest rates a little bit higher because the inflation expectations were higher. But if you look at the consumer overall, they're doing pretty well. I mean, the unemployment rate at 3.4% is certainly constructive. And they still got a lot of net worth left over from all that stimulus spending. So what's keeping us from falling in recession has actually been the strength of the consumer. So to a certain extent, for the Fed to achieve its objective, they have to stop spending. And we're seeing, some of that maybe cool off a bit, but with unemployment this low, the incentive to spend is still there. But sentiment is coming down, and sentiment does drive discretionary spending decisions. So I would expect that to cool as the economy continues to cool into this quarter.
And I mean, we've seen people pouring into tech at the beginning of this year, but you noted that 2023 so far has burned the adventurous. So what are some of the trends that some investors are following that you're not willing to chase?
Well, I mean, for instance, the S&P 500 is up 8% year to date. The equal weight version of the S&P, because the S&P 500 is so overweight the FANG names, the equal weight version is unchanged. The Dow Jones Industrial Average is unchanged. The Russell 2000 is unchanged. So if you take out the large tech names, the indices represent more of a depiction of what's happening in the economy, which is softening, and in earnings, which are negative, and then obviously the political paralysis with the Fed pausing and the debt negotiations. So the only thing that's keeping this market aloft right now is tech. And so for those who tried to get adventurous and go outside of the indices, it's been a very difficult year because there's been so much sideways action, and it's just hard to catch any trends. And maybe the tech trend's a little bit exhausted. If you think about the seasonality, you sell in May, you come back in October, that may play out a little bit. Perhaps there's a reversion to the mean. The spread between the S&P and the Dow is pretty wide historically. So maybe you get a little bit of the tech names coming off boil, some of the AI hype sort of dies down, and we spend the summer sort of rationalizing tech versus everything else.
And so then when you compare what we've seen from the University of Michigan sentiment here, but then also what we heard from a lot of CEOs on these earnings calls about the resilience of the consumer while still keeping an eye on some of the issues in the banking sector still not being worked out at the moment, what are some of the concerns that you're hearing from clients?
Overall, our clients have taken this in stride, more so than I think they have in the past. I've got gray hair. I've been at this for a while. And when the market sells off 25%, like it did last year, we typically get a lot of calls for people trying to jump off the train. That really wasn't the case this year. So I don't know if we're doing a better job, forwarding financial planning, or if people have gotten a little bit more resilient, understanding the knee-jerk activities in the market. But we're not really seeing panic. We're seeing a little bit of boredom. People starting to think, well, should I look at gold? Should I look at, some other yielding assets? Maybe I'll take the 5% I can get in money markets and not worry about this. And to a certain extent, I can understand it. If you're going to put money in the stock market for the next 3 months, don't do it. The recession's going to show up. It's going to continue to be somewhat anxious. But if you got money that you can hold for 3 years in the stock market, do it. The stock market will likely be, I don't know, earnings are supposed to be 275 at the end of 2024. You put a 19 multiple on it and you're 27% higher from here. So they understand that we got to get through this recession, that most likely it will be mild, and then recovery returns are always really great. So why not just hold and wait for that occurrence? In the near term, you know, it's anybody's bet with what's going on in Washington. But looking past the recession, things should be pretty good, I think.
And so then if you could think of just two things that you put in your criteria for how you're gauging this environment for better outperformance odds against, say, the S&P, what would they be?
I mean, that's really hard to do. We have inside markets and outside markets. This is a market right now where the S&P, because it's so weighted towards what's working, which is large cap tech, is really outperforming everything else, mid caps, small caps, et cetera. So the only place we've been able to find alpha or index outperformance is actually offshore. So the EFI's done great. And it's done great for every period going back over a year because we all expected Europe to be, you know, left for dead once you had the invasion of Ukraine. And in fact, the opposite has happened. They sort of skated through that issue. They got their house in order. Earnings have been better there than they have been here. And GDP growth has been better than expected. So, you know, the difference between reality and expectations is really all that matters. And the reality offshore has been a whole lot better than the expectations. And just to put a finer point on that, natural gas is down 50% this year. Wheat is down 20% this year. So these things that we were super afraid of that would tank Europe didn't come to pass. So very hard to outperform the S&P here unless you're in the Nasdaq 100, which is up 23% this year. Offshore, you can outperform it because Europe has actually outperformed and Japan's done fine. So international equities have outperformed, the Nasdaq's outperformed, everything else is underperformed.
We'll certainly be keeping track of all those trends. A big thank you for joining me this morning, David Waddell, Waddell Associates CEO and Chief Investment Strategist. Have a great weekend.
Great to be with you. Thank you.
All right, taking a look at shares of News Corp trading to the upside by more than 6% this morning. The stock getting a boost after the company used cost-cutting measures to lead to a profit beat for the third quarter and saw total subscribers for its consumer products cross 5 million. News Corp saw its digital real estate services revenue decline 13%. Subscription video services also declined in Q3. The Dow Jones revenue grew 9% on the quarter. Now, News Corp saw its advertising trends improve sequentially. Revenues for the quarter declining 5%, but were up 2% since last year. CEO Robert Thompson writing in the earnings release, quote, "In a period in which advertising was clearly insipid in certain parts of the world, our core non-advertising revenue has been particularly robust." So someone winning there in the ad space. All right, coming up, Biden and congressional leaders have postponed talks around the debt ceiling. What could a debt default mean for your mortgage payments? Find out next. Let's do a quick check of the market, sponsored by Flex Shares. We see the selling action picking up. We're seeing all three major indices near the lows of the day right now. The Dow off more than 80 points, about 0.25%. The S&P 500 also down about 0.33% there after that disappointing consumer sentiment survey came in this morning. And the tech-heavy Nasdaq down 0.4% or 48 points. Well, mortgage rates ticking down just slightly this week. The 30-year fixed falling to 6.35% from 6.39% the week before. Now, this is the second straight week of declines. Rates climbed to 5% in April of 2022 and have stayed above that line since then, apart from just 1 week. Although there are some signs inflation is cooling slightly, the Fed's tightening cycle has kept mortgage rates high. And there's a new complication that could actually raise rates: the stalemate in Congress over the debt ceiling. Now, Zillow reveals mortgage rates could soar above 8% if the U.S. defaults on its debts, sending the average mortgage payment up 22%. For more on this, we turn to John Lovallo, UBS U.S. Home Builders and Building Products Equity Research Analyst. Good to have you on the show here. So I'm wondering, are your predictions about what would happen with a debt ceiling default here, would they be as dire as what Zillow is projecting?
Hey, Rochelle, how are you? Thanks for having me. Frankly, look, if there's a default on debt here in the U.S., we've got some big problems that extend, well beyond what's happening in the home building industry. I can tell you that, I read the article that Zillow put out there. It's interesting. I think the math is sound. If you go from 6.5%, mortgage rate to 8.5% on a $450,000 average new home in the U.S., your payment's going to go up by about $7,200 per year. That's about 22%. Would that? I think a lot depends on how long this sort of crisis lasts, and how long consumer confidence is really strained. So we'll have to wait and see. I don't have a prediction on what it would do for mortgage rates, but we are in a situation where affordability is challenged, and so anything that negatively impacts interest rates would be negative.
And you figure this is coming at a time where, the Fed's still debating whether or not to hold interest rates at the moment. What are we likely then to see happen between now and then as we get closer to that X date?
I think that there could be incremental pressure up on interest rates. I think if you look at affordability from a housing standpoint, it's important to think of in two components. One, there's the interest rate component, which we're clearly speaking of. There's also home prices. And I think that, those are the two levers that need to adjust in order to find the clearing price in a market for a home. Home prices have remained very resilient, which I think is a testament of the demand that's out there currently. Also, the fact that there's very little existing home supply, only 2.6 months, in fact, of existing home supply on the market. So, there's various things that could happen. I think at the end of the day, we're looking at a market that is underbuilt, and there is a tremendous amount of pent-up demand that's still out there. And so we still remain, fairly optimistic on the overall market.
And as you mentioned there, you have fewer listings that also helping, push prices up, steady buyer demand as well. In terms of affordability, when do you expect that to pick back up? Because it's still a very tough time, especially if you're a first-time home buyer.
It is a very tough time. I think that what's interesting, going back to the fact that there's very little existing home inventory on the market, to the extent that folks are looking to buy a home, they are more inclined today than probably at any point in history to look at a new home. And what the home builders have been able to do, many of which own their own captive finance companies, is to help buyers find that clearing price, whether it's through incentives on lowering the actual price of the home, or actually what's been happening more often is buying down interest rates. And they have the ability to do this because of the captive finance arms that they have. And so buyers out there today that are buying new homes are not paying 6.5%, the headline rate. They're paying, under 5% in most cases. And so I think that, that sort of lever is very important to keep buying, the buying wheel continuing to turn. And we think that, that positions the public home builders in particular extremely, extremely well here in this environment.
And we know you track what people are searching for in terms of, home buying. So what sort of price points are we looking at? And we know that the Sun Belt regions were doing well, but we're starting to see some nuances showing up there as well.
Yeah. So, the Google Home search note that we put out showed that, essentially normal seasonality as we moved into, April on both the new home side and the existing home side, which is encouraging and sort of what's to be expected. The average new home in the U.S. right now is about $450,000. I think to your point, Rochelle, as you move into sort of the hotter areas of the market, the Sunbelt states, if you will, depending on the market, because this is a very localized business, home building, prices could be significantly lower. And I think that's where we're seeing the hottest demand is if you look at price points that are, sort of with a 3 handle on them. So if you think about Texas and Florida, different markets across, those states in particular where things are particularly hot, that's really where the hottest demand has been. Now, the consumer in general, or the home buyer in general, has been pretty resilient. And so there's been demand across the spectrum, but we still think that the sort of the hottest part of the market is that first-time entry-level buyer, where both the buyer, which is very need-based and driven by life events, and the home builder are able to sort of, again, meet that clearing price by maybe building a smaller footprint, maybe moving a little further out from the city than perhaps would have initially been desired. But there are ways to still make that math pencil.
All right, still some hope there for first-time home buyers. A big thank you there to John Lovallo for joining us this morning. Thank you so much.
Thank you for having me.
You're welcome. All right, coming up, Southwest's pilots union approved a strike mandate. No stranger to scrutiny in the last few months. The news comes just ahead of the busy season. The potential impact next. Southwest is facing some turbulence after pilots for the airline voted for a potential strike as extended contract negotiations came to a head. Yahoo Finance's Diane King-Hall joins us now with the details. Hey, Diane.
Hey, Rochelle. Well, nearly 100% of Southwest pilots have voted in favor of a strike. It comes after several years of negotiations as pilots push for an overhaul of the carrier's scheduling system. It doesn't mean they walk off the job right away. Now, federal law prohibits them from actually striking unless allowed by the National Mediation Board. That's the federal agency that oversees labor relations negotiations in the airline industry. Rochelle.
And you think of the timing, I mean, this does not sound good and begs the question, has there ever been a pilot strike in the summer?
Yes, so there have been strikes in the past, but they are rare. Spirit pilots went on strike in the summer of 2010. That was just for a week. It did have an impact. And the last time, though, a major carrier dealt with a pilot strike was 25 years ago when Northwest Airlines, you may remember that name, pilots struck for 2 weeks. It is a tenuous time between industry top brass and the unions. American Airlines pilots also recently voted in favor of a strike, and United pilots are out picketing today. Now, keep in mind, about 80% of U.S. air travel is handled by American, Southwest, United, and Delta Airlines. So the powers that be want to do what they can to avoid a strike. Last year, Delta pilots voted in favor of a strike before eventually striking a new deal that included pay raises over a 4-year term. This all comes at a time when the government is trying to hold the airline industry to account for controllable issues. Now, the Biden administration proposed a rule earlier this week, it feels like longer ago, that would mandate compensating passengers for flight cancellations or major delays. Why does that matter? New federal data shows that most flight delays over the past several years were due to issues within the carrier's control. And Southwest has to perform well this summer season, given what happened in the winter. And I want to give a quick check on where Southwest shares are right now. They're under a little bit of pressure, down about 8% as investors just try to read the tea leaves on what does this mean. I mean, Southwest has been having, I would say, a rough year, but it's been ongoing since the end of last year. Rochelle?
Yeah, we remember that winter nightmare. Hopefully it doesn't come to that. A big thank you there, Diane King-Hall. Thanks so much. All right, now let's talk Robinhood, a company that experienced rocketing growth during the pandemic before going public in July of 2021 at a valuation of around $32 billion, a beneficiary of low rates and the so-called meme stock craze. It saw use among younger retail investors booming. Since then, shares have had a tough ride. The story last year was weaker trading activity amid economic uncertainty and restrictive central bank policy. Since then, there's been a push to branch out and diversify revenue streams. Taking a look, the company beat the streak with its first quarter earnings, but the big announcement, a 24-hour trading platform 5 days a week. Now that launches next week. Our morning team had the chance to catch up with the company's CEO, Vlad Tenev. Take a listen.
Yeah, absolutely. I've been incredibly proud of the work that we've done to diversify the business. You know, before you had mentioned Robinhood did quite well in a zero rate environment. So the question was, can we adapt to a high interest rate environment? And when rates started their rapid rise last year, we saw opportunities for our customers. We doubled down on improving the customer experience for our more active traders. And we also rolled out products like Robinhood Retirement, which is the first IRA with a built-in 1% match, as well as Robinhood Gold, which gives customers 4.65% APY and up to $2 million in FDIC insurance. So customer behavior certainly has changed, but I think we've been doing an amazing job just giving customers the things that give them the most possible value given the current market environment. 24/5 is another example of not just giving a product that active traders really value and allows them to manage their risk better, but it's us pushing the industry forward and innovating in the same way that we did by launching zero commissions and no account minimums, the same way we did by launching fractional shares trading, and of course with the recent gold and retirement offerings. So trading should be round the clock. It should be untethered from U.S. East Coast working hours, and I think this moves it a step forward and really closer to what it should be, which is technology rather than some brick and mortar legacy institution.
Vlad, Brian here. Good to see you here back on Yahoo Finance. Do you think these initiatives will help attract the next generation of investors?
I think we've always been focused on the next generation of investors. I think for 24-hour market in particular, there's two things that two groups of people is very useful for. One is active traders who want to be able to react to breaking news no matter what time it arises and manage their risk. Also, I think it's very useful. You may have noticed on the earnings call that we've been talking more and more about how we're expanding internationally. Big part of our mission is making our services available to people outside of the US who in some cases are even more underserved than American consumers. And the experience of investing is more difficult overseas where there's very little overlap with sort of wake hours. So I think this sets us up well to serve those customers and provide them a native experience, much like those in the US get.
A product feature like this doesn't roll out unless there is a significant kind of additive or net benefit, right, Vlad? So what type of revenue additive do you foresee 24-hour trading giving Robinhood or providing to the business?
Well, I think clearly we think that this is going to lead to increased volumes, but perhaps the most important thing is just increased customer satisfaction. If you look at active trader net promoter score, that's up 30 points year over year. So our active traders are very, very happy, even in the face of kind of the challenging macro environment. Overall customer NPS is up 20 points year over year as well. And we believe if we keep innovating and keep our customers happy no matter what the macro conditions, then it's all a part of deepening our relationships with our customers even further. And 24-hour market is sort of certainly a component of that.
Vlad, in reading through your conference call and your earnings statement, I've been trying to wrap my head around the different ways that you guys make money, back to this sort of diversification idea. You're not a bank, right? When people deposit money with you guys, it's custodied elsewhere, is my understanding. But you do make interest income on those assets. How does that work? Do you pay a fee to the bank and then you can invest that money and collect interest income? Like, what's the sort of mechanism there?
So there's a couple of different products that come into play here. You might be talking about the Robinhood Gold offering, where customers get 4.65% APY on their cash and $2 million in FDIC insurance. So that's actually, it's a really interesting type of product. It's called the bank sweep product. So what happens is we sweep customer cash to a network of up to 8 banks. Starting June 1st, the number will go up to 8, which gets you the $2 million of FDIC insurance per customer. And what happens is those banks give the customer the high rate and they give us a rebate. If you look at the 4.65% APY right now, it is an incredibly competitive rate. It's hard to beat. But part of the reason for that is the Fed has raised the Fed funds rate to north of 5%. So there's just more interest income to be had, and we're passing a very large portion of that to our Gold customers.
That was Vlad Tenev there, Robinhood's CEO. Right now it's time for our chart of the day. Olive oil prices have hit a 26-year high, now costing $6,000 per metric ton. The price jump is due to a spike in demand, with the at-home cooking push during the pandemic being the leading factor. But prolonged demand has been exacerbated by supply, with olive oil hub Spain experiencing poor weather, leading to the production of less than half of the normal amount of the product. So move over egg prices. Now it's about olive oil. Right, coming up, round 2 of debt ceiling talks aren't going ahead as planned today, but the debate over the chance of default still front and center for many Americans. We get into that conversation next. Now, kicking the can down the road. Round 2 of debt ceiling talks aren't going ahead today. President Biden and Kevin McCarthy have the weekend to look forward to get another get-together early next week. But the debate over default is still front and center for many Americans, even as most think it's hugely unlikely and in absolutely no one's interest. Treasury Secretary Janet Yellen has weighed into the issue again in a Bloomberg TV interview. She says the only good outcome is for Congress to raise the ceiling. Yellen, however, hasn't been clear on action the Treasury would take if a deal isn't struck by the much-anticipated X-date. Well, joining us now to make sense of it all is Shai Akabas, Director of Economic Policy at the Bipartisan Policy Center. Good to have you on the show here. So first, talk about this issue of delaying this meeting. We know that President Biden is supposed to be heading to the G7, giving even fewer days when you have the House, the Senate, and Biden all in the same place at the same time.
Yeah, we're getting down to the wire here, and it's hard to tell whether today's postponement of the meeting is really any significant indication. My sense is that it didn't make a whole lot of logic for the two sides to come back together 3 days after they had just met, because there wasn't much new to discuss, and they need to continue these conversations at a staff level, which is what's going on this week, and they've now agreed to meet again next week. But we are only a few weeks away from possibly crossing the X date, which is when the government would no longer be able to meet all of its obligations due to the debt limit. We at BPC have projected that that's going to happen sometime between early June and early August in all likelihood. We'll be able to narrow that range as we get closer. It's obviously quite wide, but that doesn't inspire a whole lot of confidence that our leaders are going to be able to reach a deal before then. And certainly we're seeing patterns that markets are starting to get worried.
And for people who are wondering about the sort of moving date, we know Treasury Secretary Yellen had estimated June 1st would be that X date. What goes into those calculations that you're looking at in the BPC?
It's very complex because what we're dealing with here is the federal government's cash flows, and those are hundreds of billions of dollars that are coming in and out every month, and hundreds of millions of payments coming in and out. We are trying to sift through all of those, and they include everything from Social Security benefits to Medicare payments, food stamps, housing assistance, small business aid, tax refunds that go out, and tax collections that are coming in. Some of them we know with a fair amount of confidence. Others we really are doing guesswork based on prior years. Ultimately, we have a pretty good sense that this X date is coming. We know that for certain, and we can narrow the window in which it's going to occur. But even the Treasury Department doesn't know exactly when it's going to hit. So what Secretary Yellen has said is that on or after June 1st, she is not confident that they can meet all of the government's obligations. But that doesn't mean that June 1st is necessarily the X date. All that said, the clock is ticking, and if we get to June, they will be skating on very thin ice. And when you're skating on thin ice, you can fall through. That's a real concern right now.
So let's talk about some of the spending cuts that are on the table that at least have the potential to find some middle ground on. What are the standouts for you?
Well, the House GOP, the Republicans, have passed a bill that included close to $5 trillion of cuts and savings. Some of those are really non-starters, repealing some of the initiatives that the Biden administration has held as planks for a long time. So, for example, the student loan forgiveness or the clean energy tax credits that they've passed into law through the Inflation Reduction Act last year. I don't see a whole lot of common ground there, and ultimately I don't think those are going to be planks in any deal. But there are also elements that are natural places for the two sides to negotiate. For example, each year, the government has to decide how much we're going to spend on what are called discretionary programs, the annual budget. We have to do that, or else there's a government shutdown in the fall. The Republicans have passed a level that is a significant cut from where we are today, going back to last year's levels and holding those into next year. And President Biden in his budget has proposed an increase. There's room between those two. There's actually a lot of room between those two. They're going to need to find some compromise, but it's just numbers. They can find a way to get there. Obviously, these are important programs, but that's an area where they're going to need to negotiate. There's others also, like permitting reform to get infrastructure investments going more quickly, and repealing some of the unspent COVID money that I think both sides are willing to entertain. There are places that they can find a deal. The question is, can they get past the rhetoric right now where the two sides have sort of boxed themselves in, the administration saying that they need a clean debt limit increase and Republicans insisting that other provisions be attached to the debt limit.
And certainly not helping on Wednesday, President Trump at the town hall saying, I say to Republicans, congressmen, senators, if they don't give you massive cuts, you're going to have to do a default. I believe that they're going to cave. I don't believe that they're going to default. When you have that sort of narrative, though, Does that open the door for any sort of viable workaround if both sides do hit the, really do come to a stopping point?
We don't know what a world would look like where the US, the bulwark of the global financial system, is failing to meet all of its obligations. That has never happened before in the modern era. We could see really catastrophic fallout from credit rating agencies downgrading, equity markets dropping, interest rates going up both on US Treasury securities, which means costs for American taxpayers, and on consumer products across the country, mortgages, credit cards, auto loans. And economic contraction could occur where unemployment goes up, businesses and consumers start pulling back. These are all parts of the possible fallout. And we might not be able to see those coming really far in advance. That's a big concern here, is that we can't really wrap our arms around what that picture looks like because it would be such uncharted waters. I think what we can all agree on is we don't want to get to that point, and we should hope policymakers can find some common ground to reach a deal.
Indeed. We keep hearing the word catastrophic. And as you mentioned, this isn't a threshold that we've ever crossed before, so uncharted territory indeed. A big thank you for joining me this morning, Shai Akabas, Director of Economic Policy at the Bipartisan Policy Center. Have a great weekend.
Thanks, Rochelle.
All right, coming up, the EV industry is booming. 14 million vehicles projected to sell in 2023. So why are startups slumping? We're getting under the hood of the electric vehicle industry next. Tesla's price flux continues. The EV maker raising prices of its models S, X, and Y vehicles. The increase a welcome sign for investors worried about Tesla's slimming margins thanks to its aggressive price war. But the year ahead is bright for electric vehicles. The International Energy Agency expects 14 million EVs to be sold this year. That's up 35%. But even as demand surges, EV startups struggle to scale up and compete with delivery volume from industry leaders Tesla and BYD. David Callaway, Callaway Climate Insights founder and editor-in-chief, joins me now for a closer look at the future of EVs. Good to have you on the show, David. So I first want to start with what we've Good to see you. I first want to start with some of the earnings that we've seen from Rivian, Lucid, and Fisker. What is that telling us about really in these companies in particular, and really where they are in terms of competition with a Tesla or a BYD?
Yeah, this was earnings week for the EV companies, Rochelle, and we really began to see what's been starting to happen for some months now, which is the beginnings of a maturing of the electric vehicle industry. We've had 4 years of talking about electric cars, and Tesla's dominated the market in that time frame. All the other models were startups, and they had good stories, and they raised money, and they told good stories to investors. Some of them went public, some of them went SPAC, and there was a lot of fanfare. And now they're kind of reaching the point where the entire auto industry has been sold on EVs. The big guys like Ford, GM, even Toyota are ramping up massively. And so the startup companies are having a hard time. First of all, it's hard to find the money to build and scale production like you need to. Rivian, for instance, is hoping, it had one of the better earnings this week. Stock is still down. It's hoping to make 50,000 cars a year going forward. Well, Toyota made 118,000 electric cars last quarter, and Tesla made 437,000 electric cars. So, it's a big difference, and Rivian is struggling to make that. Lucid is, they're making about 2,000 cars a month. Fisker is making, slightly more of its trucks, but not that much. Another company, Lordstown Motors, is barely alive and running out of cash, it seems. So, what we're starting to see is as the industry matures, like any industry, you go from kind of startup talk and all the hype and excitement about what could be to the bigger companies coming in and saying, right, we're going to do this and we're going to scale it. So, I predict that some of these companies will fail. Others will be taken over by bigger companies. For instance, Lucid is 60% owned by the Saudis. They could step in at any time. Amazon and Ford have big Rivian stakes. So anything could happen there going forward. But as the EV industry develops, it's really going to be a race for the big boys to catch Tesla. And that's going to be interesting because we're going to start to see big boys from China coming in as well.
So then, keeping that in mind, then, this shakeout that we're seeing in the EV space, as you mentioned, some won't make it, some perhaps could be acquired then. And when you look at the number of EVs that are being sold, but then you look at the stock prices, especially for some of these companies that also have input costs that go into some of these EVs, seeing something of a divergence here. Why do you think that is?
Well, a car is an expensive thing to make, and an electric car is turning out to be even more expensive. It seems simple as just all battery, right? But the batteries are very expensive. You have to source minerals to get to the batteries. The batteries are heavier, which means that once we have fleets of electric cars on the road, and I think you said 14 million cars, this year, the IEA is also predicting, America will have 25% electric cars by the end of the decade. China will be 80% electric, Europe 60% electric. Once we have these massive fleets, they're going to be heavier. We're going to need new tires on all the cars, new roads, new bridges. But it's an expensive endeavor. And for a startup company, even one that's raised several $100 million, like Rivian or Lucid, that goes fast when you're trying to scale production and make 10,000 cars a month. So, I think that's really what's behind the kind of shakeout that we're seeing. And, in the meantime, Toyota, Ford, GM are ramping up big time. I mean, Ford said it expects to lose $3 billion on its EVs before it can get the profitability in a few years. It has $3 billion. The others don't.
And you have a lot of sort of homemade brands in China, Europe leading the way as well. But then you look at BYD. We know that Warren Buffett was hot on it for a second. We know he likes a strong economic moat. He likes a company that has a competitive edge. What's your take on what he's doing now with sort of selling and kind of moving away from BYD?
Yeah, it's really fascinating, Rochelle. I mean, we were talking about the startups, right? But BYD is the biggest EV company in the world, bigger than Tesla. And its stock has been up sixfold over the last 10 years or so. Warren Buffett got in very early. He got in right after the last financial crisis. a dozen years ago, and he's been riding a huge profit on it. So the fact that he's starting to sell, he sold about half his stake in the last 6 months. This came out of his Omaha meetings last weekend, which you guys attended. The fact that he's starting to sell says something. It may say more about his concerns about China going forward, but it also may say something about the maturation of the EV industry, right? And BYD is the largest by far in China. It wants to expand into the U.S. Will it be allowed to by the government? We don't know. Is it going to expand into Europe? It is, but it's good, slow going there. So maybe Buffett's realized he's gotten the sweet part of the EV story, and it's time to move on to something else, AI or something like that.
It certainly seems an interesting proposition, but as you mentioned, some of the geopolitical issues also to consider as well. A big thank you to David Callaway, Climate Insights founder and editor-in-chief. Have a great weekend.
Thank you, Rochelle.
It's official. Linda Yaccarino will be Twitter's next CEO. Elon Musk says the former NBCU ad sales chief will focus mainly on business operations while he looks to product design and new tech. So there you go. We have a hire there. All right, meanwhile, shares of Netflix trading to the downside. The streaming giant plans to reduce spending by $300 million this year. That's according to a report from the Wall Street Journal. Now, this comes amid a greater push for streamers to cut costs and improve profitability amid a competitive landscape. Netflix looking to cut costs after delaying its big password sharing crackdown, according to that report. Now, that change is expected to generate more revenue, and people using someone else's account will have to get their own. But now that revenue will be pushed back to the second half of the year. Well, the streamers are having a tough time balancing profitability with subscriber growth. Disney CEO Bob Iger has said the streamer needs to chase profitability over subscribers. The Magic Kingdom saw a surprise loss of 4 million paid subscribers in Q2. Iger announcing price hikes for Disney's ad-free tier later this year to help with profitability. But how many subs can these companies afford to lose? That's a key. I mean, they're struggling to hold on to accounts amid growing subscriber fatigue. Raising prices helps boost profitability, but how long until consumers decide not to pay up? Well, market analytics company Kantar revealed Netflix lost more than 1 million subscribers in Spain after the company cracked down on password sharing. Could the same happen in the US, though? When does subscribing to 5 different streaming services start to look like paying for cable TV again? We'll continue to follow this story as, of course, we see consumers getting a little tighter with their wallets. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you 11 a.m. Eastern on Monday. See you then.